Good evening, everyone. Welcome to the Rocket Revision batch for JAN'26 exam. So first things first, I don't know with what expectation you're sitting here or attending YouTube live, but what I wanted to do, I'll just make it clear so that you will know to what extent you need to cover. So I'll be doing the revision, so which will be from our That's It book, and I'll cover all the chapters. It's not like only few selected chapters, etc. I'll cover all the chapters, and followed by that we will be doing mighty 50 questions. So that's the agenda, and based on that, if you have any any other topics, etc. and all, if you have doubts, you can just ask me. So after this class or before this class, etc., I can guide you. But with respect to this, what I'm doing is that I'm focusing on all the chapters, but at the same time, there are certain procedural or theory areas, etc., which you need to read. So which I can't do anything with respect to that. But I'll tell you what are all the theory areas which are possible and which you need to remember and take it to the exam hall. But apart from that, most of the questions that you get will be application based questions only, except for the last question. That question number 6 alone will be a theory question, but otherwise everything will be practical question, that is application based only, and lot of nitty-gritties will be there, and you have to read in between the lines. Many mistakes we do because of the small things only. So that's the reason why, a number of times I always request the students to revise. Only when you are able to revise, it will be perfect, and you need to just open your ears and listen to it, and definitely it will be little faster only. I can't do anything with respect to that. Then, so this is your ABC analysis for CA final exam based on past exam questions. But the problem is that they are not following this ABC analysis. Okay, that we can say it is ABC analysis, but they are not following it. Reason being, so they will be asking question and they connect it to other areas also nowadays. So interconnected topics and all they start asking, but overview broadly, like these are some important topics which we need to cover for sure. This levy and collection under CGST, IGST, place of supply, value of supply, input tax credit, exemptions. So now this search, seizure, offence and penalty is also category A, because from that also mandatorily 1 or 2 questions they are asking. And next, this types of customs duties, valuation under customs, exemption and baggage. So these are the very important areas, and at any cost you need to cover thoroughly with respect to these areas. And as you have ample time now, because we are not in December, we are in November. So due to that reason, this 1 month before in hand, we are doing this revision. So solid 1 month time you have, so that after this revision, you will get the momentum, and with that momentum, you need to start solving as many questions as you can in these areas, Then this category B and category C is mostly like for MCQs or some other areas, etc. So there also it will be there. And here category B topics, medium weightage, but category C is actually just one time reading is sufficient. That too from this That's It book, if you are reading, that is sufficient. Even if you are not solving much problems on questions, etc. and all in this, that's not a problem. But this category A and B is the areas where you need to focus. And my suggestion is that this category area, A area topics, solved workbook if you are having, or any other compiler that you are having, you need to complete it thoroughly, that category A topics. Remaining B and C, at least selective preparation you can make. And I don't want to start with chapter number 1, etc. and all, because that will be so much boring for you. So that's the reason why I'm starting with some interesting topics, that is value of supply. Definitely I presume that you all sitting here know about GST. Please don't ask me the introduction, etc. and all with respect to this. So value of supply I'm taking first, because without value of supply and input tax credit, you cannot imagine CA final question paper. These 2 areas are must. So either in MCQ or in descriptive they will be asking. And apart from that, the next 2 areas will be exemptions and RCM. That is also very important. So first, section 15 of CGST Act deals with the value of supply. Should we quote the section numbers? Please quote. Please quote, because your paper should stand out always. And to some extent, few section numbers you need to remember, and you need to quote to the extent possible. Maybe 2 seconds extra time it will take, but it is worth it when you are writing the section numbers. At least section numbers you remember, the subsection it is okay, not required. So section 15 deals with value of supply, 15 of CGST Act. And what does it say? The value of supply will be nothing but the transaction value. Transaction value means what? The price involved in the transaction, the price actually paid or payable, agreed between the parties. So that will be taken provided two conditions are satisfied. What are the two conditions? Price must be the sole consideration, supplier and recipient should not be related. If they are related, then transaction value not applicable. If price is not the sole consideration, then also transaction value not applicable. What is the meaning of price is not sole consideration? Means apart from price, there is some other consideration that will be flowing from the recipient to supplier, which will not be ascertainable, which means it will be like non-monetary consideration or partly monetary, partly non-monetary. So those cases are price, not sole consideration. And related, we have the definition. For the purpose of related definition, you remember one mnemonic, family scope. Family scope is the meaning of related. Family. Family means what? Spouse and children, whether or not dependent. Whereas parents, grandparents, brothers, sisters of that person, if they are wholly and mainly dependent on that person, so then it will be family. Family is related. Then scope in that, S for sole selling agent, C for control. Control refers to investment more than 50% or controlling the operations or majority board of directors. And next we have two companies with a common shareholder holding 25% or more in those two companies. Then also they both are treated as related, and they both are under the common control of a third person. There is one company, below that there are two companies, so which are, even though not having any investment, but they both have the same parent company, because of which they both are related. Together they control the company. Two shareholders together invest more than 50% in the company, then also there is existing control. So total 4 points in control. First point is normal control. What is normal control? Investment more than 50%. Second one is two companies having common shareholder 25% or more. And number 3, together they control a third person, and they both are under the common control of a third person. And O for officers or directors of one another's business, and P for partners of a firm, they are legally recognized partners of a firm, and E for employer employee. So this is what related is, because whenever you see the question, you need to find whether it is a related party transaction or not. It will not be directly, it will not be given directly. You need to search for that information in the question. It will be hidden somewhere. So wantedly they will conceal that information inside somewhere in the question in one paragraph. So if it is a related party transaction, transaction value not applicable, and we need to determine the value as per CGST rules. That is about section 15.1. And 15.2 talks about the inclusions. So what are the various inclusions? Total 5 inclusions we have, starting with 15.2a, b, c, d, e. And 15.2a talks about taxes, duties and cess by whatever name called other than GST. There is a supplier who is making some supply of goods or services or both to the recipient, for which recipient will make the payment. That payment will be taken as the transaction value. And this transaction value, we need to check whether any taxes is involved other than GST, like entertainment tax, customs duty or any other taxes, but provided it is charged by the supplier to the recipient. If the supplier is not charging it to the recipient, it will not be included in the value. It should definitely be charged by the supplier to the recipient. Just because supplier makes the payment of tax, we will not include it. It should be charged to recipient, then we will include it in the value. So any tax other than GST shall be included in the value as per 15.2a. Then 15.2b, recipient is incurring some expenses on behalf of the supplier. So recipient is incurring expenses on his own account, will not be included in the value as per contract. So that information we need to check in the contract. For example, it is a FOR contract or X works contract. FOR contract means free on road. So they will undertake to deliver the goods to your location. At that time, they will be incurring some transportation cost. It is the supplier who should incur that cost. And if it is incurred by recipient, it should be included in the value. Be careful with respect to it. FOR contract means they have to deliver the goods at your place, and their liability it is to incur the transportation. But in the question it will be given that recipient has incurred the transportation on behalf of the supplier. Definitely it should be included in the value. But if the works contract is given, like X works contract or X works price is given, then in that case it is the liability of the supplier or recipient, definitely recipient. So because X works means the supplier has to hand over the goods at his factory gate or at his showroom. So which means that the recipient will be incurring the transportation on his own account. Then it will not be included in the value. So that's what I am talking about. Recipient incurring expenditure on behalf of supplier then such expenditure should be included in the value as per 15.2b. If the recipient is incurring expenditure on his own account, such expenditure should be excluded from the value. Then we have 15.2c. 15.2c says that the supplier is incurring the expenditure and charging it to the recipient. But here we need to first check, is it a pure agent or not a pure agent? Because in question, when you see the checklist, you be careful. First, you need to check pure agent. What is that pure agent means? So first, it should be the liability of the recipient, which is incurred by the supplier on behalf of the recipient. Then it is expenditure incurred as a pure agent that will not be included in the value. Example, what we have is with respect to income tax duty. Chartered accountant who is paying the income tax liability of the client, or a customs house agent who is incurring the customs duty, dock dues and other charges of his client. So all these are the liability of the recipient, but which is incurred by the supplier and recovered from the recipient. So now the supplier is acting as a pure agent, it will not be included in the value. Three conditions. First basic condition, it is a liability of the recipient. It should be the liability of the recipient. Number two, it is incurred by the supplier. Number three, on behalf of the recipient as a pure agent. Again, to become pure agent, there are four conditions. These three for application of pure agent concept. Then four conditions are there for pure agent. Number one, there should be a contractual obligation. There should be a contractual obligation where the recipient should authorize the supplier to incur this expenditure. Either that can be written or that can be oral, but there should be contractual obligation that should be given in the question. If it is not given in the question, you need to write that assuming that there is a contractual obligation like that. Then supplier should recover only the actual amount incurred. There should not be any profit out of this transaction, and supplier should not hold the title to the goods or services so procured, which means the invoice should not be in the name of the supplier. The invoice should be in the name of the recipient, and supplier should not use the state goods or services so procured for his personal purpose. It should be purely for the purpose of the recipient. So these four conditions we need to check in the question. Suppose if it is not there and you're pretty much sure that it is a pure agent expenditure, you need to write in the note that these, assuming that these conditions are satisfied, then it is a pure agent expenditure and it will be excluded from the value. Contractual obligation, only the actual amount is recovered and the invoice is not in the name of the supplier, and supplier is not using for his own purpose, personal purpose. So these are the keywords that should be present in your working note. I mean notes. When you are writing the explanation, ensure that these keywords are being presented in the notes. Okay. Then next we need to see 15.2c. Suppose if the supplier is incurring the expenditure and recover from the recipient as a pure agent on behalf of the recipient, that expenditure will not be included in the value. It should be excluded from the value. Other than pure agent, the remaining will be called as in the course of supply. Other than pure agent. So first you need to check pure agent. If it is not pure agent, then it will be in the course of supply. If it is in the course of supply, definitely it will be included in the value as per 15.2c. But in this regard, we need to check one more point. What is that? Is it incidental expenses or is it other expenses? If it is incidental expenses, means by reading the question itself, you will know that it is incidental. Means without incurring that expenses, the supply cannot be made. If it is incidental, always it should be included in the value, whether it is before or at the time of delivery of goods or supply of service, or after delivery of goods or supply of service. The usual example that we have discussed is installation expenses. Installation expenses for sale of machinery or sale of AC is incidental. Definitely it should be included in the value. And even if it is incurred after delivery of goods, it should be included in the value. Like that, incidental, only one or two only like this. But all others will be other expenses. Other expenses, you need to check at which stage it has been charged. If it is before or at the time of delivery of goods or before at the time of supply of services, then it will be included. If it is after delivery of goods or after supply of services, then it will not be included. So that point we need to check for, and that is about this 15.2c. Then 15.2d. 15.2d is about interest, late fee or penalty for delay in receipt of consideration. It can be called with whatever name. Even the discount offered is recovered will also be part and parcel of interest, late fee or other charges. So initially a cash discount will be given. Usually the typical cash discount will be like, first they will be giving the sale price, sale value, that means invoice. After reviewing the invoice, they will be mentioning that within this days you need to make the payment. Say within 10 days you need to make the payment, or 15 days you need to make the payment. If you are making the payment within 15 days, then they will be giving a cash discount. So in that case, a credit note has to be issued because the discount is after supply, but the terms are agreed before at the time of supply. So therefore the credit note needs to be given. This is usually typical, but in some questions in past exams they have given that the discount is given at the time of supply itself. That is, at the time of supply itself, the cash discount is given with the condition that the recipient should make payment within this time. Suppose if the recipient is not making payment within this time, so then whatever cash discount given at the time of supply will be recovered like that it is given. What is the treatment of that cash discount recovered? Nothing but interest, late fee or penalty for delay in receipt of consideration. The same treatment should be given. It should be included in the value. And remember one point, that interest, late fee or penalty for delay in receipt of consideration is usually assumed to be inclusive of GST. So in the question, in the absence of information, usually we take exclusive of GST with respect to all the amounts. But there are few cases where you need to always take it as inclusive of GST. First is this interest, late fee or penalty for delay in receipt of consideration, then lottery tickets, because the lottery tickets valuation itself will be into 100 divided by 128 like that it is given. So therefore for lottery tickets and interest, these two cases we need to take it on inclusive basis, even if the question is silent. Suppose if the question says something, you go by the question. When the question is silent, this is the usual assumption that we need to take. Already in the That's It book I have given some assumptions. So but if somewhere you wanted to make note also, you keep this in writing, that interest, late fee or penalty, and second one will be lottery tickets. These two places it is usually inclusive of GST. In all other places it will be exclusive of GST. This is the usual assumption. Then next, that is about 15.2d. 15.2e. 15.2e is about subsidy point. Subsidy whichever is received by the supplier from the recipient. This subsidy you need to check, is it directly linked to the price or not directly linked to the price. What is the meaning of subsidy not directly linked to the price? Which means that the subsidy is given irrespective of the outward supply, some general subsidy. For example, subsidy for setting up a factory in the backward region, subsidy for giving employment to the women, or subsidy for green energy. Like that, these are some examples of general subsidy. It is no way connected to the outward supply. By seeing the question itself, you will be able to gauge whether it is a general subsidy or not. Sometimes they will tell the subsidy amount is received in lump sum. Definitely it is a general subsidy. The moment they use the word lump sum like that, it is a general subsidy. General subsidy, what we should do in the question? Ignore it. Just ignore it for the purpose of valuation. But you need to write a note that this subsidy, which is not directly into the price, is to be ignored for the purpose of valuation. However, the same will be treated as donations, and depending upon the question, it may be conditional donation or unconditional donation, and accordingly you need to connect it to that point in your working note, I mean in the notes. So therefore not directly linked to the price, that is subsidy irrespective of outward supply, then ignored and not considered in value, but it will be treated as donations. Whereas subsidy which is directly linked to the price, which means based on our outward supply. For example, they will give, for every machinery sold, this much subsidy is received from holding company. For every service received, 2000 rupees is paid by the state government. For sale of electric vehicle, 10,000 rupees subsidy from government. Like this, all these are connected to our sales or connected to our outward supply, then it is directly linked to the price. Then in that case, you check from whom are we getting the subsidy. If it is from CGRSG, specific, only CGRSG, then to be excluded from the value. If it is already excluded, just ignore it. If it is not excluded, we need to exclude it from the value. Suppose if it is from others, then it is to be included in the value. Then others means others can be from holding company, or others can be from foreign government, or others can be from a NGO, or others can be from local authority. So that will be coming under others. Only remember CGRSG. Don't bring in local authority. Only CGSG. What if it is given as union territory? That is also covered here, because they will twist like that. Because as such per se, union territory don't have any power. Either union territory will be with state legislature, without state legislature. Without state legislature means central government. With state legislature means state government. So therefore union territory also to be treated on par with CGRSG. But local authority will come under others. Then next. So generally whether the price should be taken as after considering subsidy or without considering subsidy is an assumption which we might have to take in question sometimes. Sometimes it will be clearly given the price net of subsidy, the price after considering subsidy, like that. What does it mean? Means while arriving at the price, they already reduce the subsidy. For example, they are telling the price involved is 10,000 rupees and the subsidy somewhere is 200 rupees, and they are telling the price net of subsidy. What does it mean? There is some price X. From the text they reduce 200 rupees and what we got is 10,000 rupees, which means while arriving at the given price in the question, they already reduce the subsidy. Suppose if it is to be included, you need to add. If it is to be excluded, it is already excluded, you have to ignore it. For example, 10,000 rupees is the price, and from state government it is 2,000 rupees, and from NGO it will be 1,000 rupees. Like this the question is given. Now if this 10,000 is assumed to be after considering subsidy, which means that this 2,000 and 1,000 has been reduced to arrive at this 10,000 rupees. So what is the treatment that we need to do? First, this 10,000 we will take as transaction value, and subsidy from state government is to be excluded. In the given price already it is excluded, so ignore it for valuation. Then means ignore, already it is excluded, so don't take anything. And subsidy from NGO is to be included, but while arriving at this 10,000 rupees we have reduced it, so therefore we need to add. So then 11,000 will be taken as the value. And when the question is silent, always assume that the given price is net of subsidy, that is after considering subsidy. Mostly it will be given in the question. If the question is silent, you need to take this, because almost every question in study material and past exam they took this assumption only. So that's what I have given. If the question is silent, consider the given price as after reducing the subsidy amount given in the question, that is original price minus subsidy will be taken as the given price. Sometimes they will tell that price 10,000 rupees is without considering subsidy, and we got subsidy from state government 2,000, subsidy from NGO 1,000. Then what is the treatment in this case? First, this 10,000 as usual will be taken as transaction value, and subsidy 2,000 rupees from state government is to be excluded. But while arriving at this 10,000 we have not reduced it. So means the price is without considering the subsidy, we have not reduced. So actually as per provision we need to exclude, but in the given price we have not excluded, so therefore we need to deduct. Got it? Then subsidy from NGO. Subsidy from NGO is to be included, and in the given price it is already included, because the given price is without considering the subsidy, means we have not reduced, it's already included. So don't do anything. So the 10,000 minus 2,000, 8,000 will be taken as the value of supply. So it all depends upon the question. Be careful with respect to this, wherein when the question is silent you assume that the given price is after considering the subsidy, means already they reduce the subsidy amount from the original price. That's where in the question they gave the given price. Okay, next, that is with respect to this 5 inclusions. And first inclusion, taxes, duties and cess by whatever name called other than GST. Second inclusion, recipient incurring expenditure on behalf of supplier. Third inclusion, supplier incurring the expenditure not as a pure agent in the course of supply. Fourth one will be interest, late fee or penalty for delay in receipt of consideration. Fifth one will be subsidy from other than CG or SG directly linked to the price, that should be included in value. Whether incentive paid by Ministry of Information Technology and Electronics for the purpose of using UPI interface will be coming under subsidy. Yes, it will be treated as subsidy, keep that in mind. Usually these vendors who are accepting the UPI payments, so they will not be paying any processing fee to the acquiring bank. The acquiring bank will be like HDFC, Axis, SBI, ICICI, who are there in the payment ecosystem, will be called as acquiring banks. What they do, the moment you scan and make the payment, from your bank account the money gets debited and it will be given to the vendor account. So this will be done by these people. So these payment intermediaries or acquiring banks, they will be collecting something called as processing fee, usually for debit card transactions, whereas in case of UPI transaction they will not collect any amount. So why? If the transaction is up to 2,000 rupees, they will get incentive from Ministry of Information Technology and Electronics. That incentive, whatever they have received, will be treated as subsidy. So therefore will it be included in the taxable value of the acquiring bank? No, it will not be included in the taxable value of the acquiring bank. Don't write it as exempted. If you write it as exempted, this is wrong. So you should mention that this incentive, whatever they receive, will be taxable, However, as per section 15(2)(e), that is subsidy point, it is subsidy from central government, therefore it will not be included in the value. Be careful, don't write it as exempted, write that it will not be included in the value of taxable supply. Whether incentive paid by Ministry of Electronics and Information Technology to acquiring bank under the incentive scheme of RuPay debit card and low value UPI transactions, that is RuPay debit card also and UPI transaction also, this point is common. And what is a low value UPI transaction? Value of the transaction, not value of the supply, value of the transaction means the total amount which we pay by scanning. So that amount should be 2,000 rupees, less than or equals to 2,000 rupees. Then in that case, such incentive is provided if the amount in the transaction is up to 2,000. It is considered in the nature of subsidy by central government and not included in the value. Consequently, GST payable or GST not payable on that amount. On the incentive, GST not payable, but does not mean it is exempted. Only thing, it will be reduced from the value. You know why? Because if you treat it as exempted, unnecessarily ITC reversal will be coming into picture. Rule 42 you will bring and you will tell that this will be exempted, so ITC needs to be reversed. No, it is actually reduced from the value. When it is reduced from the value, your ITC, common ITC reversal will not arise in this case. Next, whether incentive amount received from Ministry of Information Technology and Electronics shared by acquiring bank with stakeholders. So these ICICI Bank, SBI, HDFC, etc. in turn they will share that incentive with the other intermediaries who are involved in this UPI ecosystem like Pine Labs, then Paytm, etc. who provide that QR machines or voice boxes, etc. So these people also will further receive the incentive. If they are approved by NPCI, then whatever incentive that they receive is also deemed as subsidy from central government, deemed as, even though it is not actually received from central government, it will be received from the acquiring banks, but it is deemed as subsidy. So sharing of incentive by acquiring bank with various stakeholders in digital payment ecosystem like Paytm, Pine Labs, merchant onboarding agencies as approved by NPCI. Check for the question whether it is given that it is approved by NPCI. If it is approved by NPCI, then whatever money they are receiving will be treated as subsidy from central government and it will not be included in the value. Is also considered as subsidy and not included in the value. Then condition for pure agent already we discussed, and this is one circular related to airlines which is collecting the UDF and PSF. UDF refers to user development fee, PSF refers to passenger service fee, which will be collected by the airlines from the passengers and remitting it to the airport, because airport will be providing services to the passengers. For providing that services, usually passengers have to pay money, but passengers will not pay money directly. Airlines will first pay money to the airport and thereafter they will recover it from the passengers. So this will be definitely the liability of the passenger which is paid by the airline. So airline will act as a pure agent. And in that case, so whatever money that they have collected along with the ticket fare, for example, Indigo Airlines is collecting the ticket fare 5,000 rupees, user development fee or passenger service fee 500 rupees, whether GST is payable on 5,500 or only on 5,000, only on 5,000, not on that 500, that is this. Passenger service fee and user development fee collected by the airline operators from passengers are to be remitted to airport operator and falls under expenditure incurred as a pure agent, and consequently it will not be included in the value even if the collection charges. So here the main problem arises because whenever airline is collecting this 500 rupees and remitting it to the airport will be giving some collection charges. Just because some collection charges is given to the airline, does it mean that they are making profit out of the transaction? No, they are not making any profit out of the transaction, because that's an independent transaction. First they will collect 500 rupees from the passenger and they remit 500 rupees to the airport, which means that whatever some commission they get or collection charges they get, that's an independent transaction. So even if collection charges is paid to the for the same by the airport operator to airline operator, the position will be same. Still they are called as pure agent only, even if they are earning commission or collection charges out of the transaction. And this point you should not get confused with actual consideration only to be collected, only the actual expenditure to be collected. Yes, they are collecting actual amount only, they are not making any profit out of the transaction, because they collect 500 rupees and they remit 500 rupees to the government, but thereafter they are getting the collection charges. High time there is one integrated case scenario MCQ related to this PSF or UDF. You just mark somewhere there itself. One case scenario MCQ is there related to this PSF and UDF in your ICI BOS case scenario MCQs. You need to try that. Okay, so that you try tomorrow. So today whatever portion we are learning, so tomorrow till evening you will not have any other work, na? So at that time you try to cover all those things. I mean, sorry to say that, but you will be preparing only. So you prepare this topic so that it will be like you are in the flow, and in these 6 days you are completing the entire indirect tax. Okay, so this one MCQ is there, case scenario MCQ, you try that related to PSF and UDF. High time they have not tested that, they have not tested in exam, so they can directly ask, or through that maybe based on that concept also they can make a question. Next, exclusion from the value of supply, section 15 subsection 3. Discount is divided into 3, that is discount given before at the time of supply, that is trade discount. So trade discount will be allowed as deduction, and any discount that is given before or at the time of supply, pre-supply discount is always allowed as deduction. We don't have any issue with respect to that. Only one condition, that discount should be duly recorded in the invoice. If the discount is given after supply but the terms are agreed before at the time of supply, very important, the discount is given after supply but the terms are already agreed, that's what cash discount I told you usually, or any such discount but the term should be agreed before the time of supply, then it is allowed as deduction. For that, what they need to do, they need to issue a credit note, and whenever they issue a credit note, who will issue the credit note? Supplier will issue the credit note to the recipient. That credit note will be issued under section 34. When the credit note is issued by supplier to recipient, the recipient has to reverse the proportionate ITC. Why recipient should reverse the proportionate ITC? Because there is a liability to the supplier which is being reduced. For example, I am giving you an invoice for 10,000 plus 1,800 rupees. Now, I will have a liability of 1,800 rupees. When I give a credit note for 590 rupees, now to the extent of 90 rupees, my liability should be reduced. When my liability needs to be reduced, then you have to reverse the ITC. So, 90 rupees of ITC, because initially when I give you invoice like 10,000, 11,800 rupees. So, what you would have taken, that 1,800 rupees you would have taken as ITC. And thereafter, when I am giving you 590 rupees credit note, that 90 rupees related tax component, you need to reduce it. So, means your ITC gets reversed. So, that's what it is given as a condition. Whenever it is a post-supply discount and the conditions are agreed before at the time of supply, means terms and conditions are agreed before at the time of supply, this post-supply discount is allowed as deduction, provided credit note is issued and the recipient should reverse the proportionate ITC. How will supplier know that the recipient will reverse the proportionate ITC? In this regard, we have got one circular. That circular is applicable only for your exam. Thereafter, they removed this circular. For May 26 exam, this circular is not there. And this circular talks about the recipient should give a self-declaration that they have reversed the ITC after completion of that financial year, provided against suppliers credit notes throughout the year, suppliers credit notes throughout the year for that particular recipient, if the total ITC to be reversed does not exceed 5 lakhs. For example, throughout the financial year 24-25, I have given you lot of credit notes for you, and now you need to see all those credit notes. What is the ITC component to be reversed? And if that ITC component to be reversed in total against this supplier is less than or equals to 5 lakhs, then what you need to do, you need to just give a declaration to the supplier that you have reversed the ITC. On the strength of that, the supplier will be happy that their liability already got reduced. Now they don't have to do anything with respect to that. Suppose if the ITC component to be reversed in a financial year, it's not monthly, it is financial year against that supplier, not all suppliers together, only one supplier. If it exceeds 5 lakhs, then your CRCMA should certify that you have reversed the ITC. So, how to ensure recipient has reversed the proportionate ITC? ITC does not exceed 5 lakhs in a financial year. Supplier shall obtain certificate or undertaking from the recipient. ITC exceeds 5 lakhs in a financial year. Supplier shall obtain certificate from recipient CACMA that they have reversed the ITC, and apart from that, supporting documentation is also required. Certificate or undertaking includes details of invoices along with supporting details like how they reverse the ITC. How we can reverse the ITC? Either through 3B we can reverse the ITC, or through DRC3 we can reverse the ITC. So that details. And certificate of CACMA shall contain UDIN, unique document identification number, and ITC reversed in a financial year. This financial year 5 lakhs should be seen in total under all the heads. CGST, SGST, IGST, not the head wise. It is the total, all the heads together. And the certificate on undertaking not required to be uploaded in the portal. So we don't have to submit. And moreover, this certificate is not a prior certificate. It is after completion of the year, just to ensure that the supplier, whatever credit notes they reported in their GSTR1, to that extent the liability got reduced, and they need to be comfortable with respect to that. They don't have to take any action. For that reason, they need to get it, and whenever department is asking, they need to submit this. The certificate on undertaking not required to be uploaded in the portal but made available to the officer during any proceeding. So that is about this. This may or may not be tested, but this is there. Actually, for May exam or September exam, it was important. I don't think so for January it will be tested, but this is there. Just one line. And next, whether GST is applicable on additional penal interest on the overdue loan. There is one area which will always be pricking your head. That is with respect to liquidated damages. This liquidated damages is something which you all will have a misunderstanding with respect to that. Every time you see the question, you will think that it is not consideration, but the answer will be given that it is consideration and it will be chargeable to GST like that. So today, let's complete that and remove that out of our mind. What is this liquidated damages problem is about? Listen. Liquidated damages means nothing but when you enter into contract. It is there, I will just show you, but first concentrate. Liquidated damages means whenever we are entering into contract with a person and that person has breached the contract. So then the person who committed the breach will be paying to the person who suffered the breach some amount. So this is called as liquidated damages. Now, what is the nature of this liquidated damages? We need to check. Is it compensatory in nature? When is it compensatory in nature? Something cannot be recovered, means there is a loss, irreparable loss. You just check whether the person who is receiving that compensation has got some irreparable loss. For example, you breach the contract. What is that breach? Are you delaying the completion of the contract, or are you not going to perform the contract? You are not going to perform the contract, means a loss which I have suffered is a irreparable loss, which means that this is compensatory in nature. You are going to perform, but you are going to complete it late. Then in that case, I don't have loss, but I suffer little bit of damage. For that, I agree. That is called as consideration for tolerating an act. So possibility of performance is there or not, we need to check. If there is no possibility of performance because you are stopping the contract or you are breaking the contract, that there is no possibility of performance, then in that case, whatever money received will be compensatory in nature. Then it will not be treated as consideration. When there is no consideration, there is no supply, consequently GST not payable. Is that clear? You understood? What is that you need to check? The person who is receiving that money, whether there is any loss suffered by that person or not, you need to check. There is a loss, but that loss is such that it is irreparable loss, irrecoverable loss, or the possibility of performance of contract is not there. Then it is compensatory in nature. It will not be included in the value. First of all, it is not treated as consideration, and you need to write that it is not a supply, because consideration is the crucial element to become supply. If otherwise it will not be treated as supply. The next part what you need to check is that no, it is not compensatory in nature, but it will be like penalizing in nature. Penalizing in nature means what? To discourage a person from doing such act. Example, check dishonor charges. What is the loss to the bank because of dishonor? There is no loss to the bank. Actually, there is no loss, means the person who is receiving the money is not suffering any loss, but even then he is collecting some money to discourage the person from doing such an act, to penalize a person from doing such an act. When you cross the traffic signal, there is no loss. When you dishonor the check, there is no loss. When you leave the employment before completion or without giving notice period, there is no loss. But they will be collecting some money from you even though there is no loss for them. I mean, no loss in the sense here, irreparable loss or possibility of performance, not that. There is no loss actually for them. But even then they collect it. For what reason? To discourage a person from doing such an act. That is penalizing in nature. That is also not treated as consideration, and it will not be supply. Both compensatory or penalizing in nature. But you need to write the reasoning. That's why I gave you the difference. Otherwise both are same. Both treatment is what? It is not treated as consideration and it will not become supply. Apart from these two, any other case is balancing figure. So first check for the question whether it is compensatory in nature or penalizing in nature. If neither compensatory nor penalizing in nature, it will come under others. When it is coming under others, means what? There is a possibility of performance of the contract, but there is a delay in completion for which I am tolerating your act of delay. So therefore, I will be collecting some charges. What is the treatment of these charges? This will be treated as consideration, but it will not be an individual transaction. It will be treated as consideration, and its taxability is based on the principal supply. If the principal supply is taxable, this is also taxable. If the principal supply is exempted, this is also exempted. Example, train ticket cancellation charges. Train ticket cancellation charges, is it compensatory in nature? No, there is no loss to Indian Railways because of this cancellation, because they will sell this ticket to some other person. Number two, is it penalizing in nature? Definitely no, because they are only asking us to do the cancellation if you are not traveling, so that we can allot this ticket to a waiting list person. So therefore, this will definitely not be compensatory in nature or penalizing in nature. It will be others. Others means what? They are tolerating your act of cancellation. For that, they will be collecting some cancellation charges. It will be others. Consideration for tolerating an act. What is it called as? consideration for tolerating an act. Now what you need to check is the principal supply. If the principal supply is taxable, if it is a AC ticket, usually transportation of passengers by railways, if it is AC, any AC, first class, second class or 3-tier chair car, AC ticket will be taxable. So cancellation charges for AC ticket is also taxable. And if it is sleeper class ticket, sleeper class or second class reservation, the ticket is exempted. So as that ticket is exempted, its cancellation charges is also exempted. Same way for electricity bill, you are not paying on time. So as you are not paying on time, they will be collecting from you late charges, late payment charges. Now what is the treatment of this? First, is it compensatory in nature? No, there is no loss. There is no loss to the electricity department because of not making the payment. Number 2, is it penalizing in nature? No. The intention is not that, because they will understand that not every person will be Ambani to make the payment everything on time. So due to that reason, there will be delay. So it will be coming under what? There is a possibility of performance. Yes, there is a possibility of performance. So the delay they are tolerating. Your delay they are tolerating. So it will be others. And what is the treatment? As electricity is exempted. Where electricity is exempted? For that we should know what are exemptions. Otherwise this point you cannot answer. So electricity, transmission and distribution of electricity will be exempted. So due to that reason, this late charges etc. collected for delay in payment of electricity bill is also exempted. What if it is a telephone bill? Then in that case, this late payment charges will be taxable. Why? Because telephone bill, telecom service will be taxable. So this will also be taxable. Like that, this other should be treated based on the principal supply. So this information we have in our book. I gave it in supply chapter at the end. So you can see this page number 21. GST on liquidated damages, compensation and penalty arising out of breach of the contract or other provisions of the law. And here, this is the chart that you need to remember. Liquidated damages or compensation collected for breach or non-performance of the contract. If it is mere compensation to compensate the loss or damage or injury, not treated as consideration and it will not be taxable. If you are having very old book, I think it will not be there, but otherwise it will be there. Don't worry. So you just remember the timing of the class and you take a screenshot of it. Okay. So mere compensation to compensate the loss, damage or injury. Don't, for this and all, don't go for new book pa. Don't go. Already whichever book you read, you be comfortable with that book, because that book you would have seen 1000 times by now. And repeatedly when you see the same book, the flash memory gets activated in the exam. When you close your eyes, that page number will come along with the highlights written, whatever you have written, everything will come. So that's the reason why don't change the book, keep that book. Whatever extra information is there, that you can make separately or write in a sticky note and you can paste it. Okay, but don't buy new book for this purpose. Liquidated damages or compensation collected for breach or non-performance of contract. If it is mere compensation to compensate the loss or injury or damage, it is not read as consideration. It will not be taxable. Example, compensation ordered by court or insurance compensation. Yes, insurance compensation also. Remember this in mind. Insurance compensation which is received will be compensatory in nature. Where is the possibility of performance? Sir, dead sir, you cannot revive that person. There is no possibility of performance. Car accident completely went. So thereafter, where is the possibility of performance? So that's the reason why that insurance compensation received is compensatory in nature. That will not be treated as consideration. Here not taxable means don't write it as exempted. Not taxable means not consideration means it will not become supply. So because of which GST not payable. That is the meaning of this phrase. It does not mean it is exempted. Because when there is no consideration, it will not become supply and consequently GST not payable. Then if it is specified in the contract as a part of commercial terms agreed between the parties, so that is charges are in the nature of penalizing a person to discourage such act. So penalizing a person to discourage such act, this is the area where little bit you will be finding it difficult to classify whether it is penalizing in nature or not. So for that you need to have the general understanding of the transaction. So you little bit spend some time, at least 1 minute on that to understand. So step into the shoes of the person with what intention they are collecting. Difficult only. So therefore, if at all you are really clueless, take the assumption and write. Assuming that these are not in the nature of penalizing a person, because mostly balancing figure is the answer. So charges are in the nature of penalizing a person to discourage such act. Example, check dishonor charges, traffic fines, etc. not treated as consideration, consequently it will not become supply. All other cases, it will be treated as consideration and the taxability depends upon principal supply. Example, train ticket cancellation charges. All these examples I have given, and I gave some more examples also. Check dishonor, fine or penalty, in which case it will, where it will be coming, check dishonor, fine or penalty, it will be covered under penalizing in nature. Penalizing in nature, so it will not be treated as consideration. Penalty for violation of various laws, income tax penalty, GST penalty. Is there a GST on GST penalty? No, there is no. Income tax, GST or any penalty under income corporate laws, that is security laws or corporate laws, there is no GST on that, because all these are penalizing a person to discourage from doing the act. Forfeiture of salary or bond amount, so premature termination of the employee. So he, without serving the notice period, he is leaving. So in that case, they will forfeit whatever the perquisites or whatever benefits that they need to pay, like leave travel concession or leave salary or any other gratuity, PF, etc. They will forfeit. All this is coming under again penalizing a person to discourage from doing an act. So that will not be treated as consideration. Late payment surcharge or fee. Remember, late payment surcharge or fee is not to compensate or not to penalize. It is agreeable, but its taxability is based on principal supply. Same way, fixed charges for power. So sometimes when you increase the phase, like 1 phase to 2 phase or 3 phase, etc., you need to pay some extra charges. Again, it will be covered under in the nature of what? In the nature of compensatory? No. Penalizing? No. Others. But depends upon principal supply. And here almost principal supply is exempted. Why? Because it is related to electricity. So as electricity is exempted, so these charges also will become exempted. Then next, cancellation charges, that already I told you, AC ticket cancellation charges, etc. So this is what you need to remember. And related to this, forfeiture of earnest money in certain cases, like usually immobile property contracts are there. In immobile property contracts, what they will do, first you will pay the token advance to the property owner, and thereafter you will not purchase it. So what they do, they forfeit the token advance. What is the nature of this? Compensatory in nature. Why compensatory in nature? Is there a possibility of performance or no possibility of performance? No possibility of performance. You are not going to buy, and you made him unnecessarily wait. For that, he is collecting money. So he is forfeiting that earnest money. So forfeiture of earnest money in case of immobile property contracts will come under what nature? Compensatory in nature. Treated as consideration or not treated as consideration? Not treated as consideration, because it is compensatory in nature. Then, in this regard, there is one amendment that is given. Usually RBI will be notifying from time to time as to what are the charges which are levied by the banks, etc. Accordingly, usually past practice is that banks will be collecting penal interest for the overdue loans. So any EMI, if it is not paid, they will be collecting penal interest. But now RBI is telling that it should not be called as penal interest, it should be called as penal charges. So in case of any loan other than credit card, ECB, external commercial borrowing, and trade credit, okay. So this credit cards, ECB and trade credits, these three places still even today it is called as penal interest only. But in all other loans means what? Housing loan, educational loan, or any professional loan or business loan, agriculture loan, every other loan, they will be calling it as penal charges, not penal interest, penal charges. Where we will call it as penal interest, credit cards, ECB and trade credits. So penal charges will be taxable or exempted. Neither taxable nor exempted, because it is first of all not treated as consideration, because it will come under penalizing a person to discourage from doing an act. So due to that reason, it will not be treated as consideration. In which nature? Penalizing in nature. So due to that reason, it will not be treated as consideration. Means on penal charges, what is the treatment? No GST. What is it you need to write in exam? Not a supply. Don't write exempted, ayya. Right? Not a supply. Not a supply means what? That you need to tell, as there is no consideration. This penal charges is not treated as consideration as per CBIC circular on liquidated damages. Consequently, the said activity is not a supply. Like that we need to write. And such penal charges are not treated as consideration as per above circular, as the same is penal in nature to discourage a person from doing breach. Consequently, penal charges are not chargeable to GST. What about penal interest? Penal interest will be taxable if the main interest is taxable. If the main interest is exempted, penal interest is also exempted. So when the interest will be taxable? If the interest is on loans, advances, deposits, it is exempted. If the other than credit cards, credit card interest is taxable. So penal interest for credit card is also taxable. Same way, for delay in payment of a consideration, the supplier will be collecting some interest, that will be taxable. Interest, late fee or penalty for delay in receipt of consideration. If that interest also not paid, some penal interest is levied, that penal interest is also taxable. You understood? So the taxability of penal interest depends upon the main interest involved in the EMI. But penal charges will always be not treated as consideration. Be careful in the exam. They can ask penal charges or they can ask penal interest. If it is penal charges, what is your answer? Not a supply. If they ask penal interest, what will be your answer? Depends. Depends on the EMI for which this penal interest is collected. If the interest involved in EMI is taxable, penal interest also taxable. If the interest involved in EMI is exempted, penal interest also exempted. Now here comes the another question. When interest in the EMI is taxable and exempted, interest is divided into broadly two: interest on loans, advances, deposits, interest on account of delay in receipt of consideration. Interest on loans, advances, deposits will be exempted. So as this interest is exempted, even penal interest is also exempted. Then interest on account of delay in receipt of consideration, including interest involved in credit cards, that will be taxable. Usually when you make a credit card transaction, you convert into EMI, and in every EMI there will be interest. What is the treatment of that interest involved in the EMI? That will be taxable. Interest involved in credit card EMI is taxable. So therefore non-repayment of that credit card EMI, there will be penal interest. That penal interest is also taxable. Will they call it as penal charges or penal interest? So penal interest, because this circular is not applicable in case of credit cards. So this is an area which they can be testing. Okay. Now this has got the connection to our discussion now related to this hire purchase transaction, etc. You can come back to this. What is the difference between hire purchase transaction and hire purchase financing? In hire purchase transaction, there will be two parties, hire vendor and hire purchaser. And a hire purchaser will take the asset on hire purchase, and they will be repaying the principal amount in the form of installments, and in every installment there will be interest component. That interest will be taxable because that will be treated as interest on account of delay in receipt of consideration, and it will be included in the value of the original supply, and we need to pay GST accordingly. What if the original supply is exempted? Then this particular EMI interest is also exempted. Okay, but usually in hire purchase transaction, remember, so the interest will be included in the value. There are two transaction options involving EMI that are prevalent in the trade. In view of the provisions of the law discussed above, these two options along with GST applicability are as follows: hire purchase transaction and hire purchase financing. In hire purchase transaction, what will happen? Supplier collects the consideration in installments, where such installment covers price of the goods plus interest towards time value of money. Whether this interest will be taxable? Yes, because it will come under interest on account of delay in receipt of consideration. As this interest is taxable, even penal interest for delay in payment is also taxable. It will be included in value. Whereas in hire purchase financing, supplier finances the product and collects the principal. So a financier will be involved. So the financier will collect the EMIs. That EMI interest will be called as interest on account of loans or advances. That interest will be exempted. So because of which penal interest is also exempted. Then treatment of inclusions or exclusions in the value. So first we need to see whether a particular amount is to be included or excluded. If a particular amount is to be included, in the given price it is already included, ignore it. Example, packing charges to be included, and in the given price packing charges is already included, then ignore, you don't have to do anything but write the note related to this. Number two, suppose if an amount is to be included, for example, subsidy from other than central government or state government is to be included, but in the given price it is not included, so therefore we need to add. First you need to see as per provision, then you need to see in the given question what they have done, finally what you need to do. So in the given question, subsidy from central government or state government is to be excluded. In the given price what they have done, they have included subsidy from central government or state government is to be excluded, but in the given price they have included. So what you need to do? Deduct. Okay, that's the third point. Fourth point, an amount is to be excluded and it is already excluded in the given price, ignore it. For example, discount. discount is to be excluded. In the given price, it is already excluded. So ignore it, don't consider it. Okay, but write the note. Wherever you are ignoring, but you need to write the note related to this. So these 4 principles you need to apply. Whether no claim bonus given by insurance company to insured can be treated as a deduction while computing the value of supply. Yes. Usually no claim bonus will be given by insurance company to the insured at the time of renewal premium. First year you took the insurance policy and second year you are renewing that policy. When you are renewing that policy, say if the renewal premium is 8,000 rupees, from that no claim bonus of 1,000 rupees will be given. So then what should be taken as a value? 8,000 minus 1,000, 7,000 should be taken as a value because it will be treated like a pre-supply discount. So it shall be claimed as deduction as a pre-supply discount from the value if the same is shown in the invoice as per section 15 subsection 3. Then if the transaction value fails, then we need to move on to the rules, CGST rules related to valuation. That CGST rules related to valuation start from rule 27. Rule 27 is applicable if price is not the sole consideration. Means what? There is consideration, but the consideration is not fully in money. Means it will be partly in money and partly in some other form. Then in that case, we need to first check open market value. If open market value not available, then we need to take money received plus money value of non-monetary consideration. If that is also not available, then we need to take like, kind and quality. If like, kind and quality also not available, then we need to take cost plus 10%. But remember, just because like, kind and quality is given in the question, don't jump to it. So first, if the open market value is not available, then only we go with the second. If that is also not available, then only we go with the third. Okay. So it's not like directly we go to like, kind and quality. What is open market value? Open market value means on that particular day between 2 independent persons. It can be that supplier or any other supplier. Between 2 independent parties, whatever is the price involved in the transaction, that will be taken as the open market value. But remember, open market value should be transaction value. This is like comparable uncontrolled price method, like that. Okay. On the same day, that is very, very important. On the same day, between two unrelated parties, on the same day, between 2 unrelated parties, whatever is the transaction value, that transaction value will be taken as the open market value. You can see that below. Open market value, what is the comparable time? Same date. What is the comparable value? Transaction value. And comparable supplier will be same supplier or any other supplier. And comparable goods should be same goods, literally same goods. Then it will be called as open market value. If it fails, what we need to do? Money received plus money value of non-monetary consideration. Means in the question they should give the money value or monetary value of non-monetary consideration. If that is also not available, then we will go with like, kind and quality. The difference between OMV and like, kind and quality is that OMV will be on the same date, but like, kind and quality need not be on the same day. Any nearest date can also be taken. So like, kind and quality can be any nearest date. And like, kind and quality need not be transaction value. That can be value determined under any other rule also. That can also be taken. So either transaction value or value as per rules. And who should be the comparable supplier? Either same supplier or any other supplier. And comparable goods will be same goods, but if there is a minor differences, that will be acceptable. Now, suppose if I have got more than one open market value or more than one like, kind and quality, possible, because they will twist like this. So far in question they gave only one value. We will take blindly that value only. But now they will twist by giving 3 open market values, which will be taken, whichever is lowest will be taken. Why? Because the value at the option of the supplier, so which will be lesser, that will only be selected. So select always the lower value, because in RTP in one question, equilibrium traders, like that one question is there. In that question, so they have given this. They have given like, kind and quality itself 2 values are there. So like, kind and quality itself there are 2 values. But in the answer they have taken the lowest value. Both are like, kind and quality only. But the lowest value has been taken. Keep that in mind. When multiple values are involved, we need to take the lowest value. Then, suppose if like, kind and quality is also not available, cost plus 10%. If cost plus 10%, what is the meaning of cost plus 10%? In case of manufacturer, it will be cost of production. In case of trader, it will be cost of acquisition. In case of service provider, it will be cost of providing the service plus 10%. And the data will be given in the question itself. You don't have to bother about it. If that is also not available, then rule 31. Rule 31 talks about residual value. You can see that below the table. If above is not possible, then value shall be determined as per rule 31 by applying the principles of valuation. Next, Suppose if it is not price, rule 27, price is not the sole consideration, point is not applicable, but it is a related party. Price is the sole consideration, but it is between related parties. Then we need to take rule 28. Rule 28 is not only for related parties, but also between distinct persons. Who are distinct persons? One registration of a person to their another registration is known as distinct person. One registration of a person in a state and another state unregistered establishment is also distinct person. There are 2 points in distinct person. One registration to another registration. So within the state also you can have multiple registrations. Across state definitely you will have multiple registrations. So one registration to another registration, no doubt distinct person. You have a registered establishment in this state and unregistered establishment in another state. That unregistered establishment in another state is also distinct person. What about unregistered establishment within the state? Definitely that is not distinct person. Only unregistered establishment in another state is only distinct person. And why will there be unregistered establishment? Maybe that unregistered establishment is engaged only in exempted supplies. That's why we have not got registered, because as per section 23 of CGST Act, a person who is making only exempted supplies is exempted from registration. They are not required to register. That's why we have an unregistered establishment. But if you have an unregistered establishment in another state, keep that in mind, that is your distinct person. When you make a transaction with them, definitely this rule 28 will be applicable. And even though transaction value is applicable between distinct persons, but if there is a transaction between distinct person, you need to always apply rule 28. Keep that also in mind, because what are the two conditions? Price must be the sole consideration, supplier and recipient should not be related, only two. But nowhere it is given that supplier and recipient should not be distinct persons. Distinct persons are not related persons. Distinct persons are not related persons, okay? So therefore distinct persons, we can apply transaction value if there is a price. But even then, as there is a rule 28 which is given for distinct person, the moment you see distinct person, rule 28 you need to bring. Same is the case of principal and agent transaction. Whenever there is a principal agent transaction, the moment you see in the question principal agent transaction, you need to invoke rule 29. Don't invoke transaction value. Definitely it should only be taken. Next, if it is a sole selling agent, will it come under rule 29 or it will come under rule 28? Definitely it will be coming under rule 28, not rule 29, because sole selling agent is treated as related. So write somewhere transaction between sole selling agent, okay? So transaction by sole selling agent, transaction to sole selling agent, transaction to or with sole selling agent, transaction with sole selling agent, we need to take rule 28. Rule 28, transaction with sole selling agent, we need to take rule 28, because they are treated as related. So 28 only, don't bring 29. Then, so transaction between related parties including distinct persons, rule 28. And rule 27 is applicable for both goods and services. 28 is also applicable for both goods and services. This is 28 sub rule 1. So we need to take first open market value. But for that open market value, we have one point. If recipient is eligible for full ITC, 100% ITC, then the transaction value declared in the invoice will be deemed to be the open market value. When recipient is eligible for 100% ITC, if their outward supply is fully taxable, then they are eligible for full ITC. Blocked credit should not be taken as no ITC not available, because first of all, blocked credit or inward supply used for non-business purpose are called as ineligible credit. For example, I am making sale to you. You have certain blocked credits. You have certain inward supply used for non-business purpose, but your outward supply is fully taxable. Are you eligible for full ITC? Yes. You are eligible for full ITC. You know, when you are not eligible for full ITC, if your outward supplies is exempted, or if your outward supply is partly taxable, partly exempted, then you are not eligible for full ITC. So then this point is not applicable. But otherwise, recipient eligible for full ITC means the outward supplies of the recipient should be fully taxable. Then whenever I am making sale to you, if you are eligible for full ITC, whatever value I declare in the invoice, that itself will be taken as the open market value. I can declare 1 rupee also in the invoice, that will be taken as the open market value. What if the recipient is not eligible for full ITC? Then I should ascertain the open market value, and that open market value should be taken. If recipient not eligible for 100% ITC, then OMV to be determined. Then If OMV is not available, then we need to take like, kind and quality. So we don't have the second point. So in the first rule, that is rule 27, first OMV, then money received plus money value of non-monetary consideration. If that is not available, like, kind and quality. If that is not available, cost plus 10%. If that is not available, then residual value. In the second rule, second point will be missing. So first open market value. If open market value is not available, then directly we will jump to like, kind and quality. If that is also not available, then cost plus 10%. If that is also not available, residual value. What is the second rule? Rule 28, that is related parties are distinct person. In the third rule, third point will be missing. So what is that third point? So like, kind and quality. When the third rule, that is rule 29 is applicable, principal agent transaction, first open market value. If that is not available, directly cost plus 10%. If that is also not available, then it will be residual value. So like, kind and quality, if that is not available, cost plus 10%. Then alternatively, in case of goods, at the option of the supplier for each supply, 90% of the price at which recipient supplies like, kind and quality to unrelated buyer. Recipient should not process those goods but should have been sold it as such. So what is this? In case if the recipient is eligible for full ATC, already we saw that point, that the open market value is nothing but the transaction value declared in the invoice. Another proviso is there. If the recipient is subsequently selling it as such, resale price method, wherein you take the price at which the recipient subsequently sells to unrelated buyer into 90% will be taken. But very, very important condition, that it is applicable only for goods. This is applicable only for goods. And second important condition, the recipient should not have processed it, he should have supplied it as such. Alternatively, in case of goods, at the option of the supplier for each supply, 90% of the price at which recipient supplies like, kind and quality to unrelated buyer. And here recipient should not process those goods but should have been sold it as such. Then principal agent transaction, rule 29, we need to take again open market value or 90% of the price. Here itself it is compared, either open market value or 90%, but wherever this 90% point comes, at the option of the supplier for each supply, each invoice they can decide. So which means lower value will be taken. Suppose if the 90% is lesser, they go with that lesser value. If the open market value is lesser, they go with the open market value. See, this is actually the first priority. OMV or LKQ or cost plus 10%, this is one line. Alternatively, what we have is 90% of resale price. Now you can compare between these two options and you can decide. Then in case of principal agent transaction, directly we will compare between OMV and 90% of resale price. At the option of the supplier, they can choose. What if both are not available? Then it will be cost plus 10%. If that is also not available, then residual value will be taken. So if the above is not possible, then value shall be determined as per rule 31. For rule 30, it is cost plus 10%. Cost shall be cost of production in case of manufacturer. In case of trader, it will be cost of acquisition. In case of service provider, cost of providing service. And when recipient is eligible for full ATC, open market value equals to transaction value. Therefore, invoice can be generated for any value. Even 1 rupee invoice can be taken. And in case of services, usually for services, cost of providing service will be difficult. So we can skip rule 30 and we can proceed to rule 31 directly. So rule 30 can be skipped and proceeded to rule 31 as determining cost of providing service is difficult. Even if value is determined as per CGST rules, the inclusions and exclusions is equally applicable. Keep that in mind. So if any discount is given, just because we are determining the value as per rule 27 or 28, 29, it does not mean that the discount should not be allowed as deduction. The discount can be allowed as deduction. Even the inclusions, etc. For example, if there is any subsidy, etc., that should be considered here. So therefore, even if it is valuation rules, CGST rules related to valuation, that should be compared with transaction value. But the inclusions and exclusions will be commonly applicable even for value determined as per rules. Then alternative value of 90% on resale price under rule 28 is applicable only in case of goods. And in case of transaction between distinct persons and principal agent, even if transaction value under section 15 is applicable, but we need to determine the value only as per 28 and 29. And remember, 29 is applicable only for goods, not for services. Why? Because principal agent transaction 7(1)(c) is only for goods, not for services. If I am a principal, you are my agent. If there is any service between us without consideration, that is not a supply. Only goods between us, that too agent acting on behalf of principal, then only this transaction between you and me will become supply. That's the reason why rule 29, principal agent transaction is applicable only in case of goods, not in case of services. Then next, how to determine the value of supply in case of import of service from a related person where recipient is eligible for full ITC. Import of service from a related person, which rule should be taken? Rule 28 should be taken. As per rule 28, so we need to see open market value. But when recipient is eligible for full ITC, here the value declared in the invoice should be taken. Basically here, who will be giving the invoice? There is a concept of self-invoice. So generally invoice will be given by supplier to recipient. But if the supply is covered under RCM and if the supplier is unregistered, the recipient will be giving self-invoice to the supplier. Mandatory or optional? Mandatory. Rule 47A, mandatory. Rule 47A. What is the time limit within which the self-invoice needs to be given? Within 30 days from the date of receipt of goods or services. Within 30 days from the date of receipt of goods or services, self-invoice needs to be given by recipient to supplier. Okay, keep that in mind. Even though September 25 exam, they have asked a question related to this, they connected with time of supply and they have asked the question. But this point is so crucial, definitely they will connect it in other places and they will ask. Self-invoice needs to be given by whom to whom? Recipient to supplier. In which case, supply is covered under RCM. If the supplier is unregistered, then in that case, import of service from related person, the recipient only will give the invoice. So whatever value declared in invoice can be taken, yes. So if the recipient is eligible for full ITC, keep this in mind. If the recipient is eligible for full ITC, then the value declared in invoice will be taken as open market value. What invoice? Either invoice given by supplier or the self invoice given by recipient. What if invoice is not given by the recipient? If the self invoice is not given by recipient, the value shall be nil as per this circular. Value determined as per rule 28. As recipient eligible for full ITC, transaction value deemed to be open market value. As the transaction is covered under RCM, invoice raised by recipient, and that whatever invoice raised by recipient, that value, if the invoice is not issued, value of such service shall be deemed to be nil as per this circular. And this circular is given in case of import of services from a related person. Please keep this in mind, because in 14 marks question they will connect this. They will give import of services from a related person. Everything will be given, and what you will do, open market value also will be given, and they will mention that you are eligible for full ITC. Got it? So because of which, what you will do, I will tell you. You will take the open market value given in the question, you will multiply, you will put it under RCM liability, you will also take the ITC. Gone. Waterfall effect. Entire answer is gone. You understood? One small mistake only. Okay? Gone. Fully gone. So you will be expecting 14 marks, one mistake only, 2 marks they will reduce. No, they will reduce 7 marks. 7 marks. Be careful, for one mistake you are going to lose 7 marks and you will get only 7 marks. That too, another mistake means, needless to say, some 2 marks or 3 marks you will be expecting for the 14 marks question. While deducting the marks, crazily they are deducting the marks. While giving marks, you know, like, so they are thinking 100 times to give, but while deducting, no second thought, deduct, fully deduct. So be careful with respect to that, don't commit mistakes. That's what. So therefore, import of services from a related person, even though it is covered under RCM, but the value declared in invoice will be taken if the recipient is eligible for full ITC. If the recipient is not giving any invoice, then the value shall be deemed as nil as per CBSE circular. Means no need to pay GST? Yes, no need to pay GST in this case. Value of supply in case of corporate guarantee to related person located in India. This is already tested. This particular amendment you mark as very, very important, not yet tested. This amendment was there, but not yet tested in exam. This already they have tested. Corporate guarantee, personal guarantee, etc. But in MCQ somewhere it will be connected, or in IBS also it will be useful. Value of supply in case of corporate guarantee to a related person located in India, that is given in rule 28 sub rule 2. Corporate guarantee means definitely it will be only between companies. So it will not be between partnership firms, or it will not be between AOPs or BOI. Corporate guarantee is only by one company to another company. And what should be taken as a value? And is it between related companies or unrelated companies? Only related companies. That's why we are talking about rule 28. When rule 28 is applicable in case of related party transaction. And 1% of the guarantee amount or the actual consideration, whichever is higher. But that 1% of the guarantee amount should be taken per annum. So 1% of the amount of guarantee offered per annum or the actual consideration, whichever is higher. And here there is one point. If recipient is eligible for full ATC, the value declared in invoice shall be deemed to be the value. And 1% is computed on the loan sanction but not on the loan disbursed. For example, if the loan is for 100 crores but the loan disbursal is only 30 crores, that 1% should be computed on 100 crores or 30 crores? On 100 crores, not on 30 crores. 100 crores into 1% or the actual consideration which is paid, whichever is higher should be taken. What if actual consideration is not there? That 1% itself will be taken. But remember, it is on the loan disbursed, not on the, loan sanction, not on the loan disbursed. And recipient can avail ITC with respect to GST paid by the supplier. So say for example, holding company X Limited, a subsidiary company Y Limited. X Limited is giving the guarantee to Y Limited. X Limited will pay the GST on the corporate guarantee, and that GST they will recover it from the subsidiary company. Can the subsidiary company take ITC with respect to that? Yes. What if they have got only 30 crores but the GST is paid on 100 crores into 1%? It's okay. Whatever invoice which is raised by the holding company to subsidiary company, they can take ITC. Recipient can avail ITC with respect to GST paid by the supplier irrespective of the loan disbursed. If loan is for a fixed term, for example 4-year loan or 5-year loan, that 1% should be multiplied with 4 years or 5 years as the case may be. So if loan is for a fixed term, then 1% computed for each year and GST payable at the time of issuance of guarantee. For example, year 1 only they need to pay GST for next 4 years or 5 years? Yes, year 1 itself. So today I have given the guarantee, like holding company or any related company given guarantee to another company, then in that case today itself they need to compute into 1% into number of years and they need to discharge the liability. It's not like it is spread over the years. You know, when it is spread over the years, if it is an annual renewal, if it is a fixed term guarantee, day 1 itself. However, in case of annual renewal, GST is payable each year based on the value determined each year. And if loan is for part of a year, say for example 9 months, then what we need to do? 1% into 9 by 12. That 1% is common, but into 9 by 12 should be taken, is considered in value. Then they have given some clarification with respect to some special points. With respect to takeover of loans, say for example, so corporate guarantee is with the ICICI Bank and the ICICI Bank loan is now taken over by HDFC Bank. In that case, what is the treatment? So when the loan is taken over by another bank, whether the another bank is insisting on a new corporate guarantee or not, we need to check. If the another bank is not insisting on new corporate guarantee, then we don't have to bother about anything. If they insist on new corporate guarantee, then again there is a new corporate guarantee, again that 1% point will be applicable. So takeover of loan by one bank from another without issuance of a fresh corporate guarantee or renewal of corporate guarantee would not tantamount to provision of corporate guarantee service, therefore GST not applicable. From this, what is another point which we can interpret? Suppose if there is a fresh guarantee, definitely again the GST payable will arise on the guarantee offered, because on the fresh guarantee, whatever is the amount for which we are giving guarantee, that should be taken. Where corporate guarantee is provided by more than one entity, what is the amount on which GST is payable by each co-guarantor? So first we need to see whether the 1%, for example say this, there are three companies like A Limited, B Limited and C Limited. Three companies gave guarantee to X Limited, all are related. Now in this case we need to first check what is the guarantee that is offered. The guarantee is say for 100 crores. And how that 100 crores is divided between them. Say A Limited 50 crores and B Limited is 40 crores and C Limited is 10 crores. Then in that case, is there any actual consideration involved? Yes, there is an actual consideration that is involved. That is X Limited is paying to A Limited 40 lakhs and as consideration, and X Limited is paying to B Limited somewhere like 20 lakhs. And X Limited is paying to C Limited some 10 lakhs. So this is the actual consideration. Now what we need to do in that case? First, A, 1% of the guarantee offered, 100 crores into 1%. What is 100 crores into 1%? Say it is for 1 year. For the time being, we'll take 1 year. 100 crores into 1% will be 1 crore. 1 crore or B, actual consideration. What is the actual consideration? So 40 lakhs plus 10 lakhs plus 20 lakhs, 40, 50, 60 and 70 lakhs. The actual consideration is 70 lakhs. 1 crore or 70 lakhs, whichever is higher. Whichever is higher is what? 1 crore will be higher. This 1 crore should be taken as the value. The value will be 1 crore. But this 1 crore, how we can charge it as GST to A Limited, B Limited and C Limited? Simple. You divide it based on the ratio in which they are giving the guarantee. What is the ratio in which they are giving guarantee? 5:4:1. So in the ratio, 1 crore divided between who? A, B, C. In what ratio? 5:4:1. 5:4:1 ratio, that should be divided between A Limited, B Limited and C Limited, that 1 crore. You understood what we need to do? Suppose in the same way, if the 100 crore into 1% equals to 1 crore and the actual consideration instead of 70 lakhs, if it is say 120 lakhs, 120 lakhs is the actual consideration. Means, sir, what has happened? Instead of giving 40 lakhs as the actual consideration, 40 lakhs, 10 lakhs and 20 lakhs, they gave an actual consideration of 70 lakhs and 30 lakhs, 70 lakhs, 30 lakhs and 20 lakhs as the actual consideration. Then 70 plus 30 plus 20, 120 lakhs. So whichever is higher, so what will be taken as the value? The value will be taken as 120 lakhs, means actual consideration. So what should be the value in case of A Limited? Whatever is the actual consideration received by A Limited. What is the actual consideration received by A Limited? 70 lakhs should be taken. In case of B Limited, what is the actual consideration received by B Limited? That will be say 30 lakhs. So that 30 lakhs should be taken. And what is the actual consideration by C Limited? That will be 20 lakhs. So the 20 lakhs should be taken. You understood? First you need to take actual consideration, total actual consideration or 1% of the guarantee offered, whichever is higher. Depending upon that, you need to arrive at the answer. Suppose if 1% is higher, then what we need to do? That 1% you need to divide between those 3 entities or 2 entities. In what ratio? In the ratio in which they have given the guarantee. What if the ratio is not available? Equal. What if the ratio is not available? We need to take equal. Suppose if the actual consideration is higher, then what we should do? That actual consideration you need to take and you need to see what is the actual consideration that they have received, and that will be taken as the value. Is it clear? Mark this as very, very important because it is not tested. This point is not yet tested. They gave only the corporate guarantee, but they did not give corporate guarantee by multiple people. That is not tested in exam so far. Okay. If the total consideration paid to the guarantor exceed 1% of the guarantee offered, value of supply to be considered actual consideration received by each co-guarantor. And suppose in other cases, means the actual consideration is less than 1%, then proportionately on 1% of the guarantee offered by each co-guarantor in the absence of ratio, equal proportion to be taken. Whether intra-group corporate guarantee liable for RCM. Say this, if supplier and recipient are located in India, it will be FCM and supplier has to issue invoice. Definitely this rule is applicable. If supplier is outside India and recipient in India, if they are related, then also this rule will be applicable, but it will be covered under RCM. Now what is supplier in India? That is company which is corporate guarantee between 2 companies, in that the supplier company is in India and the recipient company is outside India. Whether this rule is applicable? No. This rule is not applicable, because see this rule is applicable only when the related person is located in India. If the related person to whom the guarantee is offered is outside India, this rule is not applicable. Then what we need to do? Related person outside India, rule 28 sub rule 1 will be applicable. This rule will not be applicable. 28 sub rule 2 will not be applicable, but 28 sub rule 1 will be applicable, which says that you take open market value, if not available like kind and quality, if not available cost plus 10%, that should be taken. Is that clear? This is also not tested. This is also not tested. What they will do? The company which is giving guarantees in India and to which it has given guarantees outside India, we all will apply rule 28 sub rule 2. We take 1% of the guarantee offered per annum or the actual consideration, whichever is higher. So beautifully we will write, shabash, we wrote correctly like that, we'll think 1 mark also will not get, because that rule itself is not applicable. We need to take open market value or like kind and quality. That rule should be taken in that case. Next, say this, another point. Whether valuation in terms of rule 28 sub rule 2 will apply. Already I gave that, don't worry. This is also important. So whenever the corporate guarantee is between related person, but it is export of service, means what? The recipient is outside India. Rule 28 sub rule 2 shall not apply to the export of service or providing corporate guarantee between related persons. In such case, value will be determined as per regular rule, that is rule 28, OMV or LKQ, or rule 30 as the case may be. This is also important. So these two, any of these two can be tested in exam, this attempt. In case of personal guarantee, who will be giving personal guarantee? By the director of a company to the company, there will be personal guarantee. And what should be taken as a value? We have a CBIC circular which says that the value shall be taken as nil. Already we studied in one place where the value is nil. What is that? Import of services from a related person where the invoice is not issued, then the value shall be taken as nil. Same way, in case of personal guarantee by the director of a company to the company, the value should be taken as nil. In case of personal guarantee by director to a company without consideration, even though it is supply under 7(1)(c), how it is supply under 7(1)(c)? Director of a company and company will be treated as related, and the value will be as per rule 28, but it should be taken as nil as per CBIC circular, because there is a RBI circular which is in force which says that consideration should not be paid by the company to the director who is giving the guarantee. Consideration should not be paid in case of personal guarantee by director to a company. However, personal guarantee by ex-director to the company will be 7(1)(a), and whatever actual consideration is there, that will be taken as the value. For a consideration is supply under 7(1)(a) and value shall be as per section 15, that is transaction value will be taken. This is in case of personal guarantee. Personal guarantee already tested in exam. I don't think so that will be asked. Okay, already they have tested. How the value of internally generated services by head office to branch office should be taken. This also already tested, but again it can be tested because it is one area which a lot of students will ignore and go. That is, head office will be providing some services to its branch which is not procured from third party. If it is procured from third party, then ISD concept will be applicable. For example, there is a head office. That head office is receiving start audit services, and that start audit service bill they have paid. Now the concept of ISD will come, wherein they will take the ITC on that start audit bill and they will distribute it to all the branches. But it is not that we are talking about. We are talking about internally generated services like certain IT department cost or HR department cost or accounts department cost. All these are common expenses throughout the company. So this internally generated service, including the salary cost, will be recovered from the branch or it may not be recovered from the branch. It's a company policy. So GST law will not talk anything about it. So say a company having a head office which is in Bengaluru and having branches in multiple states. So they will have some IT department cost which is common for all the branches. Accounts department common for all the branches. HR department common for all the branches. So to these people they pay some salaries and they will be incurring some cost, etc. So all this will be borne by the head office, or maybe head office can recover it from the branches, because these are common overheads which can be apportioned or may not be apportioned. It's a company policy. Now, in that case, what will be the value? Definitely it's a transaction between distinct person, because head office in Bengaluru, branch office in other states will be treated as distinct person. In case of distinct person, the value should be determined as per rule 28. As per rule 28, we need to take OMV, etc. So here one point we should see. What is that first point that we check in rule 28? If the recipient is eligible for full ITC. If the recipient is eligible for full ITC, that is branch office is eligible for full ITC. When branch office is eligible for full ITC, what should be taken as a value? The value declared in invoice. What if invoice is not given? The value shall be nil. This is the third place where we come across value shall be nil. The first place where we have seen is that import of services from a related person, where the self invoice is not issued, the value should be taken as nil. Personal guarantee by director to the company, so in that case also the value should be taken as nil. Third place, when the services, internally generated service, are provided by the head office to the branch office, where the branch office is eligible for full ITC, then the value declared invoice, if the value is not issued, then also the value should be taken as nil. So whether amount is recovered or not from the branch office by head office, is the recovery mandatory? Not mandatory. It is up to that. That's what I told you. So it is a company policy. It's not mandatory. If they want to recover or they may not recover, that is up to them. Value under rule 28 will be invoice value. Value can be nil if the invoice is not issued. and OMV is nothing but transaction value. That's why we are taking like this. What if branch office is not eligible for full ITC? If branch office is not eligible for full ITC, then we need to take open market value, correct? And here there is a point in circular which says that if the head office is going to recover the money from the branch office, then they need to determine the open market value. Whatever money that they have recovered, irrelevant of that, the open market value should be taken. What if the amount is not recovered by head office from branch office? Then the value of supply will be nil. This is again exception to rule 28. So total 4 places where we have the value will be taken as nil. So what are the 4 places where the value will be nil? Number 1, import of services from a related person, where the invoice is not issued, self invoice is not issued. Number 2, personal guarantee by director of a company to the company, there also the value will be nil. Number 3, head office to branch office internally generated service, branch office eligible for full ITC, if invoice not issued the value will be nil. Number 4, head office to branch office internally generated services, where recipient not eligible for full ITC, but the amount is not recovered by head office from branch office, and also the value should be taken as nil. These are the only 4 places where they have given through circulars the value should be taken as nil. Keep that in mind, okay? So later on you write this somewhere and you keep it, so that one day before the exam you can cross check with respect to this. Above treatment is applicable even in case of import of service from related person. Already we discussed that point, I connected it. Then next one, rule 31A. Rule 31A will be applicable in case of HC block. What is HC block? Specified actionable claims. Specified actionable claims is only covered under supply, and all other actionable claims are excluded from supply. H for horse racing, C for casinos, B for betting, L for lottery, O for online money gaming, and G for gambling. In case of casinos, we have rule 31C. In case of casinos, remember C for casinos, rule 31C. B for online money gaming. B for online money gaming, 31B online money gaming. All other cases it will be 31A, because in exam when you are writing, you cannot write rule 31 because rule 31 is a different rule. So therefore you need to write rule 31A or B or C. For that reason you should remember C for casinos, 31C. Online money gaming will be 31B, whereas all other cases it will be 31A. In case of casino, what should be taken as a value? The money deposited for the purpose of purchase of tokens or coins or chips will be taken as the value. Initially, at the time of entering into casino, we deposit some money to play the game and we get the coins that will be taken as a value on which GST will be payable. And in that coin, some coins may not be used and it may be withdrawn. In that case, is there any reduction in liability? No reduction in liability. We have to pay GST on the initially deposited amount even though you withdraw anything. Suppose if there is any winnings, on that winnings are we required to pay any GST? No, only on initial deposit. So therefore initially you deposited 10,000 rupees and thereafter you got some coins, say you got some 10,000 coins, and this 10,000 coins now went to 20,000 coins. Any new GST? No. This 10,000 coins you redeemed and you got your money. Any reduction in GST? No. So you have to pay GST only on the deposit. Suppose if you have withdrawn the money and again you deposited, whether again you need to pay GST on that? Yes. That is given in rule 31C. Valuation in case of specified actionable claim, rule 31C. Supply of actionable claim in casinos, value of supply will be amount paid or payable for purchase of the token, chips, coins or tickets for use in casinos by or on behalf of the player, and any amount returned or refunded by the supplier. Initially you deposited 10,000, you spent 3,000 rupees and 7,000 rupees you are withdrawing. So will they give credit note because of which liability get reduced? No. The supplier to the player, including the amount paid or deposited with the supplier which is not used by the player, shall not be deductible. Shall not be deductible from the value of supply. Same way, any winning amount which is used by the player without withdrawing. So say initially they deposited 10,000 rupees and they have won some 10,000 rupees extra. Now they have got 20,000 rupees. And should they pay any GST on this? No. On winning amount which is used by player without withdrawing shall not be considered as amount paid to or deposited with the supplier. What if that winning amount they have withdrawn and again they have deposited? Because they will withdraw today and they will not get sleep properly. So because today itself I made 10,000 rupees profit, means if I invest 1 lakh I will make 2 lakhs like that. So again next day they will go and they will deposit that 20,000 rupees. Should they pay GST? Yes. Okay. So because government has done proper research to identify how people will behave, accordingly GST liability has been made. And the same point is applicable even in case of rule 31B, online money gaming. For online money gaming also same way, that initially in the wallet how much ever recharge you are doing for doing the betting online money gaming platform, that will be taken as the value. Same points, whatever we discussed in casino, the same points is applicable even for online money gaming. The only difference is that in casino we purchase these chips, coins or tickets, but here amount paid or payable or deposited with supplier by way of money or money's worth. Money's worth means points. You recharge the wallet for the points, that including virtual digital asset, cryptocurrency by or on behalf of the player. And what is online money gaming? You deposit some money to play the game with the expectation of winning that money. That is online money gaming. But online gaming is there. That is, you spend money to play the game. Like for example, GTA. So GTA will be coming under GTA or Minecraft, or lot of PS5 games are there. That will be online gaming. So in case of online gaming, the regular transaction value is applicable. This rule is not applicable. Only for online money gaming, this rule will be applicable. Keep that in mind. And so what is the regular transaction value? That is also nothing but the deposit amount. Initially how much our money that you have spent, but only thing we will not be able to withdraw anything out of that. And in case of 31A, we have horse racing, betting, gambling and lottery. For lottery we have a separate provision. What should be taken? Price printed on the ticket or notified by organizing state, whichever is higher, into 100 by 128. So recently they increased the rate to 40%. Whether that will be applicable for your exam? No, that will not be applicable for your exam. It's for May 26 exam. For Jan 26 students, you don't have to bother. You need to take into 100 by 128. So because the rate of GST on specified actionable claim for your exam is 28% only. So price printed on the ticket, whatever is the price printed or notified by the organizing state. Organizing state may increase the price or may decrease the price. We need to take whichever is higher into 100 by 128. Then 28 by 128 will be taken as the GST component. And remember, this is the another place where we have seen it is always on inclusive basis. One is interest, another is this lottery ticket. They will not specify in the question, but we need to take on inclusive basis. Whereas in case of horse racing, betting and gambling, we need to take 100% of the face value of the bet. That is whatever money that is paid by all the people as a bet value, that should be taken, not the commission earned by the totalizer. Totalizer is the one who is conducting the betting transaction. So they will get commission, not on that GST is payable. For example, if 1000 people are placing bet on IPL matches, now whatever may be the course of action, so either team, say for example CSK and MI, and if MI wins or CSK win, whatever the case may be, government will always win because they will get GST on the total bet value. On all the 1000 people who place a bet, on that GST will be payable. Is that clear? So that is 100% of the face value of the bet or amount paid into the totalizer, not on the commission earned by the totalizer. That is this. Next, rule 34, relevant date for determination of exchange rate for the purpose of valuation and computation of GST. What should be taken as the relevant exchange rate? This is applicable in case if the transaction is denominated in foreign currency. Usually in case of import of goods or import of service, export of goods or export of services, the transaction is usually in foreign currency, but for payment of GST we need to convert into Indian rupees for payment of GST. How to convert? At what exchange rate we need to convert? In case of goods we need to take CBIC rate, and in case of services we need to take GAAP rate. So CBIC rate will be given in the question itself. GAAP rate also will be given. If not also, GAAP is nothing but average of the buying rate and selling rate. They will give buying rate and selling rate. You just do the average of that. That will be taken in case of services. For goods, CBIC. For services, GAAP. Which date? You should determine the time of supply. First, you need to determine the time of supply for the transaction. As on the time of supply, whatever is the CBIC rate, that should be taken for goods. In case of services, first determine the time of supply. As on the time of supply, whatever is the GAAP rate, that should be taken. And you recognize the transaction at that Indian rupees and you discharge the GST liability. What if the actual realizable value is more than this? For example, you took 61 rupees and you paid, and thereafter 65 rupees is the exchange rate. Then on that 4 rupees extra, are you required to pay any GST? No. Exchange gain or loss shall be ignored for the purpose of GST, and the GAAP rate is nothing but average of the buying and selling rate. Then we have rule 32. Rule 32 is in case of some specified transactions, and those specified transactions are 5 transactions. Number 1, that is foreign exchange transaction including money changing. Here it will be like you are giving one foreign currency against Indian rupees, money changing. The previous one is transaction denominated in foreign currency to convert into Indian rupees, what we are doing. Because there the transaction is some goods or services. Here the transaction itself is converting from one currency to another currency. That is this foreign exchange transaction including money changing. Then what should be taken as the value? They have given two options, and remember rule 32 is a optional value, means either we can go with transaction value or we can determine the value as per rule 32. So if you go for transaction value, what should be taken? In case of foreign exchange transaction including money changing, example, I am an exporter and I get $10,000 and I give the $10,000 to the bank, and bank will give me Indian rupees. So means I am selling the $10,000, bank is buying dollars. That transaction I am talking about. So in that case, the bank will be collecting from me currency conversion fee or currency markup fee. That currency conversion fee or markup fee will be taken as the transaction value. Okay, transaction value is currency conversion fee or currency markup fee. Whereas if you go for rule 32, again in rule 32 there will be two options, 32.2a and 32.2b. 32.2a says that check one of the currency converted involves Indian rupee and RBI reference rate is available for that day. For example, rupee per dollar, that equals to 83 and 87. 83 is bid and 87 is asked. So therefore either 83 or 87, whichever relevant. For example, if you are selling dollars, bank will be buying, so 83. If you are buying dollars, bank will be selling, so it will be 87, depending upon either bid or ask, buying rate or selling rate, and the RBI reference rate. That difference should be taken, multiply with the units of the currency. So one of the currency exchange involves rupee and RBI reference rate available for that currency on that day. Either bid or ask and RBI reference rate into units of currency should be taken. Then one of the currency exchange involves Indian rupee and RBI reference rate not available on that day. Usually some days the RBI reference rate may not be available. Then what should we take? We need to take gross amount in Indian rupees into 1%. What if both the currencies exchange involves foreign currency? Convert both the currencies into Indian rupees using RBI reference rate into 1%, whichever is lower should be taken. When both the currencies exchange involves foreign currencies, convert both into Indian rupees into 1%, whichever is lower. For example, we are exchanging pound for dollars. So then in that case both are foreign currency. So convert both into Indian rupees using RBI reference rate into 1%, whichever is lower. What if we don't have the RBI reference rate for this? Then you cannot determine the value under rule 32.2a. Then what should be taken? We need to go with transaction value only. When rule 32 is not possible, transaction value is only possible in that case. Then there is option 2. That option 2 is 32.2b, which says you need to take the slab rate model. So the slab rate model will be first to 1 lakh, it will be first slab. Gross amount exchanged in Indian rupees you need to take. First to 1 lakh, first slab. Then beyond 1 lakh to 10 lakh, second slab. And beyond 10 lakhs will be third slab. If you are in the first slab, 1% of the gross amount or 250, whichever is higher. For example, the gross amount exchange in Indian rupees is 20,000. 20,000 into 1%, 200. 200 or 250, whichever is higher will be 250. Suppose if the gross amount is 80,000. 80,000 into 1%, 800 or 250, whichever is higher will be 800. Like that when you go to the second slab. So what is the fixed amount? 1,000. How 1,000? 1 lakh into 1%. Because in the first slab, 1%. 1% of the gross amount or 250, whichever is higher. So therefore the fixed amount will be 1,000 in the second slab. So when you go to the second slab, 1,000 rupees plus 0.5% of the gross amount exceeding 1 lakh. For example, if it is 8 lakhs, first 1 lakh it will be 1,000 and remaining 7 lakhs it will be 0.5%, that is 3,500. 3,500 plus 1,000 it will be 4,500 will be taken. Like that exactly 10 lakhs. Exactly 10 lakhs, first 1 lakh it will be 1,000. Next 9 lakhs into 0.5%, 4,500 plus 1,000, that will be 5,500 will be in the second slab, third slab. So in the third slab, what is the fixed amount? 5,500 plus 0.1% of the gross amount exceeding 10 lakhs. For example, 80 lakhs. First 10 lakhs it will be 5,500. Remaining 70 lakhs into 0.1%, it is 7,000. 7,000 plus 5,500, that will be 12,500. That should be taken. Like that, what is the maximum amount? The maximum amount will be 60,000. Now, this option 1 under rule 32, but here you need to remember 32.2a and 32.2b, that you need to remember, because in question they will ask determine the value under 32.2b, like that they will ask. 32.2b is what? The slab rate model. 32.2a is that conversion, bid rate or ask rate and RBI reference rate, that point we should take. So this 32.2a and 32.2b has to be decided in the beginning of the financial year, and that option decided will be applicable throughout the financial year. Please concentrate. Either transaction value or rule 32 value we need to decide with respect to each invoice. So with respect to each invoice, either transaction value or value under this rule at the option of the supplier for each supply. For each invoice, they can decide transaction value or rule 32. But inside rule 32, you have again 32 2A and 32 2B. The 32 2A versus 2B you have to decide in the beginning of the financial year. Option to be decided in the beginning of the financial year, which shall be applicable throughout the financial year. Keep that in mind. And next, 32 sub rule 3 is applicable in case of air travel agent. For air travel agent, what is the transaction value? Nothing but the commission earned by them will be the transaction value. Suppose if they want to go for rule 32, what should be taken? They need to see what is the base fare in case of ticket booking, and the 10% of base fare in case of international booking, and 5% of base fare in case of domestic booking. 5% of base fare for domestic, double. 10% of base fare in case of international booking. What is base fare? In every ticket, air ticket, there will be base fare, fuel surcharge and other charges. So the base fare only should be taken. Don't take the total value into 5%. Total ticket price into 5% you should not take. In the ticket price, see what is the base fare, on that 5% should be taken or 10% should be taken. Then rule 32 sub rule 4. This is in case of life insurance business. For life insurance business, we need to see what type of policy it is. If it is a risk cover policy, we need to take entire premium received as the value. And for transaction value also, we will take entire premium collected only. So risk cover policy also entire premium. So there is no difference between transaction value or rule 32 when it comes to risk cover policies. Then other policy, single premium annuity policy, means there will be only one premium. That one premium into 10% should be taken. Remember these percentages, 10% of single premium. Then reinvestment policy, what should be taken? Premium collected minus amount allocated for investment. For example, insurance company is collecting 1,80,000 rupees, they put in the equity market. Then 1 lakh minus 80,000, only 20,000 will go into their pocket. That should be taken as the value. So gross premium minus amount allocated for investment. But very important condition is that they have to intimate to the policy holder at the time of collecting the premium as to how much they are going to allocate it for investment. If they are not intimating, then it will be other policies. For other policies, what should be taken as a value? 25% of the premium in the first year and 12.5% of the premium in the subsequent year. What is first year premium? Every insurance company will have first year premium and subsequent year premium. First year premium is with respect to the new policy subscribers who took the policy, they will be paying premium, that is first year premium. Already those who took the policy in the previous years, they will pay premium now, that will be subsequent year premium. So first year premium into 25, subsequent year premium into 12.5%. This will be in case of life insurance business. And next we have rule 32 sub rule 5, that is buying and selling of second hand goods. In case of purchase and sale of second hand goods, we need to take the margin scheme. Margin scheme is sale price minus purchase price. So this is applicable only to a second hand dealer in goods. Second hand dealer in goods means they are buying second hand goods and they are selling second hand goods. So selling price minus purchase price, that is margin scheme. What if the selling price is less than the purchase price? Then in that case the margin will be negative and they are not required to pay any GST. And ITC should not be availed on purchase, that is an important condition. Then in case of repossession, repossession means what? So there is a financier who gives the financing to the asset and the EMIs are not paid on that asset. So financier will usually repossess the asset and they sell it to recover their money. So they will also be eligible for this margin scheme. So what should be the sale price? The price at which the repossessed asset is sold. But what will be the purchase price? There is no purchase price because they are repossessing it. So they cannot take the original purchase price also. So a depreciation has to be given. What is a depreciation? The original purchase price to the defaulting borrower minus 5% for every quarter or part thereof. From when to when? From the date of purchase till the date of disposal of that repossessed asset, we need to give the depreciation because the asset has been used, right? So we need to deduct. And always in GST, remember the capital goods are considered as the life as 5 years. So that's the reason why 5% calculation. 5% for 1 quarter means 1 year it will be 20% and 5 years it will be 100%. So straight line method only the depreciation is given. But only thing, rather than calculating yearly, we are calculating it for 5% for every quarter or part thereof. From the date of purchase till the date of disposal of repossessed asset. Then there is one notification 8/2018, there also margin scheme is applicable. So all the places where margin scheme is applicable, I just connected in this place. Okay. So first I discussed with you a second hand dealer in goods who is buying second hand goods and selling second hand goods. Second point, I told you that there is a person, financier, who did the repossession of the asset and he sold that repossessed asset. Third point is related to a person who purchases the motor vehicles. The first point and second point is applicable to any kind of goods, but the third point is applicable only for motor vehicles. You are buying a new motor vehicle and you are selling that after usage. You also can go for margin scheme. So sale price is the price at which you are selling that motor vehicle. What is the purchase price? WDV as per Income Tax Act. You are buying a car. This is applicable only for car, only for motor vehicles, only for motor vehicles, only for motor vehicles, not for others. So it is applicable only for motor vehicles. Please keep that in mind. Only for motor vehicles it is applicable. In case of sale of motor vehicles, which motor vehicle? Used motor vehicle or newly purchased motor vehicle? Newly purchased motor vehicle. Value can be sale price minus depreciable value under section 32. As per 32 of Income Tax Act, you will calculate the WDV, right? That WDV should be taken, and that difference is the value on which GST payable, provided ITC is not availed on purchase. Here also, what if the margin is negative? Ignore. If the margin is negative, you need to ignore. That is common in all the places. Wherever you go for margin scheme, if the margin is negative, ignore that. You don't have to pay GST. And this you mark as important. So this can be tested again. Notification number 8 2018. Actually, this entire rule 32 is important for this attempt because for last 2 attempts I did not check any question related to this. Previously and all they used to give one 5 marks question on this. So therefore this can be asked, or at least in MCQ they can be asking, because it's long time due. That to forex transactions is due, and other things also they tested. Forex transactions they have not tested. Then in case of coupons or vouchers, these coupons or vouchers we need to take the redeemable value. So usually the transaction value is the sale value. That coupon or voucher will be sold for some amount, that will be the transaction value. But in case of rule 32 they are telling you take the redeemable value, means whatever is the goods or services supplied against that voucher, that will be taken as the value of the voucher. That is this. But this point is actually redundant now, because we have a CBSE circular on vouchers which says that vouchers are neither goods nor services. So therefore we don't have to pay GST on that voucher, but there will be some supply of goods or services against this voucher. This voucher will be treated like a consideration. We will supply some goods or service against the voucher. That supply of goods or service against this voucher only will be taken as a value. For example, you have got, so say 500 rupees max voucher, and you go to the max showroom, garment showroom, and you purchase garments worth 1500, and you redeem 500 rupees worth of voucher and pay 1000 rupees. Now what will be taken as a value of the garments? 1500, not 1000. So this 500 rupees is not like a discount. So 1500 rupees, and GST is not on voucher. GST is on the sale of garments. Okay. So voucher is nothing but a consideration. That's why this point is relevant in today's context, because anyhow we take the value of goods or services that is supplied against a voucher as the value. Got it? Then notified services between distinct person without consideration, the value will be nil, and if ITC is available on purchase, but actually this notified service not yet notified. So this rule 32 sub rule 7 is practically irrelevant in today's context. And what should be the transaction value in case of purchase and sale of second hand goods? We need to take the sale value. Suppose if margin scheme is not applicable, what they need to do? They need to take sale price. And even if they sell at a loss, for example, I am purchasing a car at 1,20,000, I am selling at 1 lakh. If I am going for normal scheme without this rule 32, I need to pay GST on 1 lakh, because there even if I am selling at loss I need to pay. But if I go for margin scheme, I don't have to pay GST. So transaction value is sale value. Then there is one important point related to TCS. TCS under Income Tax Act will not be included in the value. For example, there is a dealer who is selling the motor car which is more than 10 lakh rupees. There is a TCS of 1% which is collected. Now in that case, so the seller will collect price of the motor car and 1% TCS plus 28% GST and compensation cess. Now while computing TCS, should the GST be included? No, that is Income Tax Act. While computing TCS, GST will not be included. TCS is computed only on the price. This is for Income Tax Act. Now for GST, while computing GST, whether TCS should be included? No, because clearly they have given a clarification stating that this TCS is not an income tax. This TCS is an interim levy, not having the character of tax, because it is not a tax on income, it is a tax on expenditure. So that should not be included in the value, because TCS, when I am collecting, it is your expenditure. You are buying a car, you are not selling the car, you are buying a car. So it is your expenditure. On that the TCS is collected. That's the reason why it should not be included in the value. So TCS not to be included in the value under section 15(2) of CGST Act. Any taxes, cess, duties shall be included in value, but TCS is not includable in value as it is an interim levy not having the character of tax. Then there is business facilitator and business correspondent scheme, wherein bank will appoint business facilitator and correspondent as agent for the purpose of extending their banking operations. So these BC and BF will be collecting the service charges from the customer and will be remitting it to the bank. Now in that case, that service charges will be included in whose value of supply, bank or the BC or BF? It is bank only. But this BC or BF will get a commission for doing this collection of service charges. On that commission only they need to pay GST. So business correspondent or business facilitator provide the services to the customer on behalf of the bank, and the bank, behalf of bank to the customer, and the customer will pay the service charges. This service charges will be remitted to the banking company. So even though they are collecting the service charges, but the service charges will be included in the value of supply of banking company, and the banking company will give them commission. So that particular commission will be taken as the value of supply. Okay, that is with respect to business correspondent or business facilitator. So, and we also know one point, business facilitator or correspondent will pay GST under FCM or RCM. Business facilitator to bank will be always RCM, but business correspondent to bank will be FCM. So in case of business correspondent, GST payable under FCM on the commission, and in case of business facilitator, GST payable under RCM by the banking company on the commission. So this is with respect to value of supply we have completed. Okay, and so while discussing itself, some key points in question and answers I have connected. So don't expect me to solve the question and answers. If I start solving the question and answer, then this will become like an exam oriented batch or a fast track batch. Okay, and I will not be able to complete the given portion. The portion is like mountain height. Okay, lot of things are there to be discussed, but I am trying to cover each and every point in the form of like one single line. So which is the crux in a question. When you solve a question, whatever information that is required, I am connecting here itself during that discussion. Now it is your job. What is your job? Don't ask me to do your job. Your job you should do, because I am not writing the exam. You have to write the exam. So you need to practice the question. My job is to do the revision and give you all the core points. Based on that, you need to practice and you need to come prepared for the tomorrow's discussion. Got it? So that is your job. Today revision, tomorrow practice, again tomorrow revision, day after tomorrow practice. Like that you keep, so that in the 6 days we will try to wind up the entire indirect tax. That you should keep as a target. Okay, next. So you need a break. You take a break for 10 minutes and then we will continue with another chapter, that is input tax credit. Okay, don't go for coffee, tea break and all. Just use washroom and come back. Transition kuda மேல இருக்கு பாரு, மேல transition இருக்கும் பாரு, அதான். Okay, stages. So related to this repossession point, there is one query, that is whether this repossession should be from a registered person or unregistered person. Repossession from an unregistered person, only this margin scheme is applicable. If the repossession is from a registered person, this margin scheme is not applicable. So this, in case of repossession, purchase price equals to original purchase price. But when this will be applicable? When this will be applicable? Only if repossession is from, only if repossession is from unregistered person. Only if such repossession is from unregistered person. So if the repossession is from a registered person, whether you avail ITC or not avail ITC, margin scheme is not applicable, and we need to go with the regular transaction value only. Then one more point related to molds and dies. It's not that important, that's why I did not discuss that, but I'll just discuss it orally. Listen. So whenever molds and dies is given by the original equipment manufacturer to the component manufacturer, you are the component manufacturer, I am the original equipment manufacturer. I enter into contract with you to buy the car doors from you, or I enter into contract with you to purchase a component from you, and that components you need to make using the molds and dies given by me. So I will be giving you the molds and dies. Using that molds and dies, you will be making the components as per contract. Anyhow, I should give it to you. So will it be included in the value of the components that you manufacture? Definitely no. 15(2)(b) will not come. See, for components, you are the supplier, I am the recipient. As per contract, I should give that molds and dies to you, and I gave it. So that you have used in manufacture. Now it is an expenditure incurred by me on my own account. So that will not be included in value. When it will be included in value? As per contract, if you are required to buy the molds and dies, but which is supplied by me, then it will be included in the value. That is recipient incurring expenditure on behalf of supplier. So what you need to remember here? Simple. The component manufacturer receiving the molds and dies from the original equipment manufacturer, its cost will not be included in the value of components. If as per contract, the component manufacturer is not required to buy that molds and dies. Suppose if as per contract, the component manufacturer should buy the molds and dies, but which is given by the OEM free of cost, then its value should be included in the value. Just remember this point, that is sufficient. Okay. So if you want, I will just write that here. So there is a component manufacturer receiving molds and dies from OEM. Component manufacturer receiving molds and dies from OEM. Free of cost? Yes, free of cost. Component manufacturer receiving molds and dies from OEM free of cost. Now you need to divide into two. As per contract, OEM should provide. As per contract, OEM should provide. As per contract, OEM should provide. So they are only giving. So include in value or not include in value? Molds and dies not included in value. Molds and dies not included in value. Suppose as per contract, component manufacturer should purchase. As per contract, component manufacturer should purchase, but given by OEM, then molds and dies included in value. So component manufacturer receiving molds and dies from OEM free of cost, they are receiving. As per contract, OEM only should provide, so they have provided. It will not be included in the value. It will not be included in the value of what? Component manufacturer. Same way, as per contract, component manufacturer should purchase, but it is given by OEM free of cost. OEM means original equipment manufacturer. Then the molds and dies should be included in the value. This is what you need to remember for that molds and dies point. Then we are moving on to input tax credit chapter. In this input tax credit, we need to understand first section 41 read with rule 36 sub rule 4. What are the conditions for availment of ITC? So that condition mainly it is only matched ITC can be taken, that is given in rule 36 sub rule 4. What is matched ITC? That ITC which is reflected in GSTR 2B of the recipient is known as matched ITC. So in this regard, section 41 deals with availment of ITC in GSTR 3B. Availment means taking credit in GSTR 3B. Section 41 read with rule 36 sub rule 4. So GSTR 1 is a return that will be filed by every registered person containing the details of outward supply. Our supplier will file GSTR 1 and will mention our purchase as his outward supply sale to B2B, that is registered person. He will mention it in GSTR 1. Based on the supplier's GSTR 1, the data will be reported or auto-populated in GSTR 2A and GSTR 2B of the recipient. Both 2A and 2B will contain the inward supply details, but 2A will be a dynamic document wherein whenever supplier adds the invoice, immediately it will be coming in 2A. But even if he is not filing, it will be coming in 2A. Only when he files the return, it will be coming in 2B. So therefore 2B is only the relevant document for availment of ITC, 2A is only the reference document. So whenever the supplier makes any changes to GSTR 1 in 2A, it will be updated. So 2A is a reference document, but really ITC availment is based on 2B. So 2B also contains the inward supply details, but 2B will have a cutoff date. What is that? If all the GSTR 1s which are filed by the due date, that will only be reflected in 2B of the recipient, and 2B will take the data not only from GSTR 1 but also from the IFF. IFF refers to invoice furnishing facility. A person who is under QRMP, if our supplier is under QRMP, he will be reporting his B2B supplies in the invoice furnishing facility by 13th of the month following every month. So whatever data which is filed by in GSTR 1 by 11th of the month following every month, and IFF data by 13th of the month following every month, these two data will be reflected in our 2B, which is generated on 14th morning, and in that whatever ITC is there, that can be taken as ITC, that is the matched ITC. GSTR 3B contains a consolidated details of outward supplies, inward supplies, GST payable and GST paid, reported by every registered person. The difference between 2A and 2B is that 2A is dynamic whereas 2B is static. TDS, TCS details will be reflected in 2A but it will not be reflected in 2B. And details of invoice if GSTR 1 filed after due date. If it is filed after due date, it will not be coming in 2B, but it will be reflected in next month 2B, but it will be reflected in 2A immediately. And the purpose of 2A is just for reference, but 2B is for availment of ITC. And whenever supplier reports the details of outward supply in GSTR 1 or IFF and it is filed by the due date, then it will be reflected in GSTR 2B of the recipient. This is known as matched ITC. And to this matched ITC, we need to make certain adjustments. Then it will be called as self-assessed ITC, and that self-assessed ITC can be availed in GSTR 3B. So what is that self-assessed ITC? First, ITC as per 2B minus three things which are reflected in 2B but ineligible. What if it is not at all reflected in 2B? Then ignore it. It is reflected in 2B but ineligible, so we need to reduce. What is that? That is blocked ITC used for non-business purpose, used for exempted supplies. So blocked ITC you should not take, and blocked ITC, next inward supply used for non-business purpose, that is personal purpose, inward supply used for exempted outward supply. These three may be reflected in 2B but you should not be taking it, so you need to reduce it. Plus we need to add 3, which is reflected in 2B, reflected in 2B or not reflected in 2B, not reflected in 2B. If it is reflected in 2B, anyhow it is there. Not reflected in 2B, even then we can take, what is that? GST paid under RCM, reavailment of ITC reversed earlier, plus ITC not availed in earlier tax period but it was reflected in 2B of that period which we have not availed at that time, we can avail it now. So can we avail self-assessed ITC? Yes. As per section 41, we can definitely take self-assessed ITC, but rule 36 sub rule 4 says only matched ITC to be taken. So these are the three exceptional cases where even though it is not reflected in 2B, we can still take ITC as per section 41. So we need to make these adjustments to the question. Be careful, they will be giving the data, but you need to be careful or cautious about it. If it is there in 2B, but if it is blocked ITC, ineligible ITC, don't take, reduce it. It will not be there in 2B, only in some special cases you will be able to take ITC, that is these 3 cases. RCM, reavailment, ITC pertaining to earlier tax period not availed during that time. Okay. Then reversal of ITC if supplier not filed GSTR 3B, this is section 41 read with rule 37A. What is that? Supplier reports the invoice in GSTR 1 and he filed it by due date, already we saw just now, and because of which it got auto populated in the 2B of the recipient. Based on the 2B of the recipient availed the ITC in 3B self-assessed. Up to these 3 steps just now we have seen. And thereafter what happens? Supplier did not file 3B by 30th September of the succeeding financial year. Who? Supplier. Supplier did not file GSTR 3B, means he filed GSTR 1 but he did not file GSTR 3B by September 30th of the succeeding financial year. Then whatever ITC which is already availed by the recipient needs to be reversed by 30th November of the succeeding financial year. So literally there is a gap of 2 months. By 30th September your supplier should have filed GSTR 3B. If not, we need to reverse, and the data is automatically available, and we need to reverse the ITC after September 30th but before November 30th of next financial year. If you reverse it beyond November 30th, we need to pay interest. If not reversed by November 30th of next financial year, then interest will be payable at the rate of 18% from the date of utilization till the actual date of reversal or payment. So reversal or payment, if you have balance in ITC, you will reverse. If you don't have balance in ITC, you will add it to the liability. And here we need to take 18% from the date of utilization. What is the date of utilization? First you need to check the month in which balance in ITC falls below the availed ITC. You availed 1,50,000 as ITC. What is the balance in the ITC? 1,50,000 means you have not utilized. Say the balance came down to 1 lakh, means 50,000 you have utilized. Like that you need to take from the date of utilization till the actual date of reversal. And again, as and when supplier files GSTR 3B afterwards, can we re-avail the ITC? Yes. ITC reversed earlier can be re-availed without any time limit, but the interest cannot be re-availed. So the interest is the loss here. So first we avail the ITC, we are reversing the ITC, again we are re-availing the ITC, and the interest will not be applicable if, number 1, they have maintained the sufficient balance in ITC, then interest will not be applicable. Number 2, if they reverse it by November 30th, then also interest will not be applicable. This about section 41 read with 2 rules. One is rule 36 sub rule 4, you have to remember this rule number, and then rule 37A. These 2 rule numbers you have to remember. 36 sub rule 4 talks about matched ITC, 37A talks about supplier not filing GSTR 3B by September 30th. Then section 49 subsection 5 talks about the manner of utilization of ITC. So we have to remember some 4 principles in this regard. Principle number 1, there is no restriction with respect to IGST. What does it mean? IGST credit can be utilized for payment of any GST liability, and any GST credit can be utilized for payment of IGST liability. And between CGST, SGST and UTGST, cross utilization is not possible. Okay. So therefore CGST credit cannot be used for SGST, or SGST credit cannot be used for CGST, etc. Then with respect to compensation cess, it can be adjusted only for payment of compensation cess. So it cannot be used for any liability, including IGST liability. Same way IGST credit cannot be used for compensation cess liability also. That is this principle number 1. Principle number 2 is the priority. IGST credit should be first utilized for payment of IGST. Thereafter between CGST, SGST in any manner, any proportion. So but depending upon the question we need to follow that. So what you need to do, check the liability of CGST, SGST, how it is. Suppose if CGST is more liability, SGST is less liability, give more credit to CGST of IGST credit, more credit to CGST and less credit to SGST. So case to case basis you need to decide in the question, and you need to determine that. Then all other credits, first for payment of its liability and thereafter for payment of IGST. Then we need to exhaust which credit first? First we need to exhaust IGST credit. Before utilizing CGST and SGST credit, the credit of IGST should be completely exhausted, and order of utilization of IGST credit as specified in principle 2. So first IGST credit needs to be exhausted. Keep that in mind before setting off CGST and SGST credit. Then for payment of IGST liability, first which credit we will use? IGST credit. Thereafter CGST, Thereafter, SGST or UTGST. So this is for payment of liability. What is the difference between principle 4 and principle 2? Principle 2, we have one credit, multiple liabilities. So we have seen the order. But here we have multiple credits, but there is only one liability, that is IGST liability. First IGST credit, then CGST, then SGST or UTGST credit. IGST credit after utilizing for payment of GST, IGST liability can be used for payment of CGST and SGST in any manner, any proportion. So multiple answers are possible in exam. Definitely your answer may not match with the suggested answer. So what you should do in that case, you just add one more column. For this computation of net GST payable, you add one more column. In that one more column, you just put the total, so that even if the headwise, if there is any difference, but the total will be matching, because of which you will not be deducted with the marks, because IGST credit for CGST, SGST, any manner you can use. For example, you see this, if you have a CGST liability, CGST, SGST and IGST. CGST, SGST and IGST, we have gross liability say 5,000, 5,000 and 5,000, and we have IGST credit of 10,000. What we should do with respect to the 10,000? First we will utilize for payment of 5,000. Thereafter we can use it for CGST, SGST anyway, correct? Thereafter we can use it for CGST, SGST anyway. But what I told you, just check the liability. In that liability you divide. So therefore we will divide it equally, 2,500 and 2,500. But ICI may not have done that. They would have done differently. But the total net liability will not change, because there is a CGST and SGST credit. That CGST, SGST credit is 2,000 and 2,000. So now what will happen to our liability, net liability? The net liability will be 500, 500 and 0. Now you put a total column. The total column will have 1000. So even though you have done anyway, but the total will not be changing. So the total will be 1000 rupees. Because what ICA can do, CGST they would have adjusted 3000 and SGST they would have adjusted 2000. See, already CGST credit, SGST credit 2000, 2000 is there. Beyond that they will not reduce. So if that be the case, if CGST 3000, SGST 2000, then CGST will become 0, SGST will become 1000. So alternative answers do exist. So that's the reason why you just put a total, so you will get it. And 5,000, 5,000, 2,000, 2,000. What is the liability? 3, 3 equal. That's the reason why we are equally dividing it. Okay. But first we adjust IGST, then only we will use CGST and SGST credit. So IGST credit after utilizing for payment of IGST liability can be used for payment of CGST and SGST in any proportion. So multiple answers possible. So depending upon CGST, SGST liability, it should be apportioned. Then second important point, GST compensation cess can be availed and utilized only for payment of GST compensation cess, not on anything else. Which means in my outward supply, if I don't have compensation cess, I will not take ITC on my compensation cess inward supply. So outward supply there should be compensation cess liability. Then condition for availment of ITC, section 16. So we have seen two sections. One is section 41, availment of ITC, 49 subsection for utilization of ITC. Condition for availment of ITC, section 16. Only a registered person can avail ITC. So unregistered person cannot avail ITC. Number 2, the inward supply should be used or intended to be used. Used for existing now, intended to be used. We are going to use it in future, still we can take ITC. In the course or furtherance of business, in the course of business for the existing business, furtherance of business for some business which we are going to start in future, still we can take that. Recipient, then third condition. First two, only registered person, inward supply should be used or intended to be used in the course or furtherance of business. Third, recipient should be in possession of tax paid document. What are the tax paid document? Either the invoice given by supplier to recipient or the invoice given by recipient to supplier, that is self invoice. Or number 3, debit note. Number 4, bill of entry. Number 5, ISD invoice. So these are the tax paid documents on the basis of which they can take ITC, and they should be in possession of tax paid document. If the invoice is missing, they need to reverse the ITC. They would have taken, but if the invoice is missing, they need to reverse the ITC. recipient should have actually received the goods or services. Invoice is dated January, but the goods are actually received in February. Then they can take ITC only in February, not in January. And it should be received, actually received goods or services. But in this regard, there is one point called as deemed delivery. When goods are delivered to a third person on our behalf, the date on which they received the goods or services is deemed that we have received the goods or services, and we can take ITC with respect to that. That is a concept of deemed delivery. Concentrate. If the goods and services are delivered to a third person on behalf of the registered person, on the date on which the third person has received the goods or services, the registered person has received the goods or services, and they can avail the ITC. That is a concept of deemed delivery. That is bill to ship to transactions. The shipping address has received the goods or services, the billing address can take ITC. Now that particular point wherein even though you have not actually received the goods, but some other person on your behalf has received the goods or service, it is deemed that you have received the goods or services, you can take ITC. So this condition will be fulfilled. Recipient should have actually received the goods or services. Relating to this point, you can see here deemed delivery. When goods are delivered to any person or service are provided to any person on the instructions of the recipient, the date on which such person has received the goods or services, it is deemed that recipient has received the goods or service. In case of bill to ship to transaction, billing address can avail the ITC. Then look into this, availment of ITC on the date on which goods are handed over to transporter in case of X works contract. This is one amendment wherein in case of X works contract, the goods are handed over by the supplier at his factory gate. So the recipient, you are the recipient, you will be sending your transporter to pick up the goods from my factory gate. I am the supplier. Now the day on which I hand over the goods to your transporter, it is deemed that you have received the goods, because on your behalf only I gave it to the transporter. The day on which transporter has received the goods, it is deemed that you have received the goods, so you can take ITC. So here original equipment manufacturer, say a car manufacturer, loaded the car in the truck on 10/8/2025, and the date on which car is loaded in the truck, but it is a X works model. X works model means what? So OEM factory gate itself they need to deliver. As and when they deliver in their factory gate, it is deemed that the goods are handed over to you. So therefore the deeming fiction says that the dealer has actually received the car on 10/8 itself. So therefore 10/8 itself they can take the ITC, even though the car is actually received in their factory gate at a later date. So ITC can be taken by dealer when OEM hands over the goods to the transporter at the factory gate, that is on 10/8, even though goods are received by the dealer at a later date. So later date, say for example, it need not be 25th of August, it can be somewhere of 8th September 2025. Even then, what will be considered as the date of receipt of goods? Only 10/8. That is the date on which goods are handed over to the transporter only should be taken. Okay. And is this applicable only for cars? No, all type of goods which is on X works model. X works means what? The goods which are handed over at the factory gate of the supplier or at the showroom of the supplier, that is called as X works model. The above clarification is applicable in case of all types of goods. What will happen if the goods are lost during the transit, which means this dealer can avail ITC for which month? August month or September month, assuming that they have actually received in September month, whether they will avail ITC for August month or September month? August month. August month itself they will avail the ITC, even though the car is actually received in September month, but they will avail ITC for August month. And during this transit, what has happened? The goods were lost or destroyed, etc. Then in that case, what they should do? They should reverse. August month they would have already taken, but the goods are destroyed, which is a blocked credit, so they need to reverse that. If the goods are lost, destroyed or stolen or disposed as gift or free sample during transit, it is blocked ITC and ITC avail if any needs to be reversed. That is with respect to this deemed delivery concept, and there is one amendment related to that OEM contract, etc. and that can be tested. That OEM is important. That OEM point is important, that can be tested. Then next, come back to this. So first 4 conditions we saw. Only a registered person can avail ITC. Inward supply should be used or intended to be used in the course or furtherance of business. Recipient should be in possession of tax paid document. Recipient should have actually received the goods or service. And how to avail this ITC? Any ITC will be availed only in GSTR 3B. So they need to enter the details in GSTR 3B. Recipient should have filed the returns in GSTR 3B. And there are 3 conditions in the hands of the supplier. What is that? Supplier should have furnished the details in GSTR1, because if supplier is not filing details in GSTR1, it will not be reflected in 2B, so we cannot take ITC. So supplier should add the details in GSTR1, and those details which are added by supplier in GSTR1 should be reflected in our ITC, 2B as ITC available. It should not be under ITC not available. If it is under ITC not available, we cannot take. So in our 2B, even though supplier filed GSTR1, in our 2B, we have ITC available, ITC not available. If it is coming in ITC not available, we cannot take ITC. That is this. So GST paid on inward supply should be reflected in 2B under ITC available and should not be restricted. So as per section 38, few cases this will be restricted. What are the cases where ITC will be restricted? Number 1, supplier is a newly registered business, or supplier filed GSTR1 not filed 3B for earlier tax periods, or supplier GSTR1 liability is more than 3B for earlier tax periods, or supplier availed ITC in 3B more than his 2B in the earlier tax periods, or supplier defaulted in payment of tax and the default continues, or the supplier has to pay 1% of our liability, of their liability through cash ledger, but they did not discharge it through cash ledger. These are the situations which are listed out in section 38, which is not your mistake, your supplier mistake, but you will be penalized for that. So therefore the supplier will do this mistake, because of which now when they are adding in GSTR1, it will be reflected in 2B under ITC not available. So you will not be able to take ITC. This section 38 information is given in the returns chapter. So you please check that. Page number 158. Page number 158. In the following cases, even though supplier declared the details of outward supplies in GSTR1, ITC can be restricted in 2B as per section 38. This can be tested for the theory question. What is that? Supplier is a newly registered business. Supplier filed GSTR1 but not 3B. This is not for this period, some earlier past periods. Then supplier liability in 1 greater than 3B. Supplier's ITC in 3B greater than 2B. Supplier has received demand notice and default in payment of tax and the default continues. Or supplier defaulted in payment of 1% of gross liability through electronic cash ledger in terms of rule 86B. In all these cases, the ITC will be reflected in 2B, but under which column? ITC not available column. And again, whenever supplier rectifies his mistake, it will be moving to ITC available, and at that time we can take. So is it a temporary exclusion or permanent exclusion? Temporary exclusion only. It's not a permanent exclusion. And supplier starts rectifying his mistake. That means the difference in 1 and 3B he rectifies. The difference in 2B and 3B ITC he rectifies. Or the demand notices and outstanding demand order he will discharge. Or he will pay 1% of his liability through cash ledger. Or he regularizes his return. Even though he is a newly registered person, he regularizes his return. In all these circumstances, what will happen? So far it was under ITC not available. It will move to ITC available and we will be able to take ITC. This point will be tested in practical. So what they will tell, that somewhere in August month, it was in ITC not available, it was restricted, and now the supplier complies with the provisions, like that they will tell, which means which was restricted in August, now you are in December, say, therefore you can take ITC. Got it? But we will ignore it. What we will think, okay, we availed ITC at that time, like that we will think, no. So we will be able to take ITC now because it was restricted at that time and we would not have taken ITC at that time. Got it? That is about section 38. And there is one permanent exclusion pa. What is that permanent exclusion? If you are paying CGST, SGST in the another state. If you are paying CGST, SGST in another state, it will also be restricted in 2B. Keep that in mind. Okay. So one more restriction is there. One more restriction is there in 2B. That is, CGST and SGST paid in another state. CGST and SGST paid in another state. CGST and SGST paid in another state. So it will be under ITC not available. It will be under ITC not available. And is it permanent exclusion or temporary exclusion? Permanent. Permanent exclusion. You will never be able to get it in future. So why will there be CGST, SGST paid in another state? On interstate inward supplies there will be IGST, no? Why it will be CGST, SGST? Say for example, hotel accommodation. You are located in Tamil Nadu. For the sake of any consultancy or audit, etc., you visited another state and there you stayed. That hotel owner will raise CGST, SGST invoice because for him the place of supply will be location of immovable property. For example, you visited Mumbai, Maharashtra, location of supply also Maharashtra, place of supply also Maharashtra, therefore it is intrastate supply. He will be charging CGST and Maharashtra SGST, but you are registered in Tamil Nadu, you cannot take ITC with respect to that. That is this. CGST, SGST paid in another state cannot be taken as ITC, and here it is a permanent exclusion with respect to this. So other points whatever we have seen is temporary exclusion only. Then look into the continuation to this. So conditions, total 8 conditions. In that 8 conditions, first 2 basic conditions, and that is only registered person can avail. Inward supply should be used or intended to be used in the course or furtherance of business. 3 conditions from recipient point of view. He should have actually received the goods or services. He should be in possession of tax paid document. He should have filed a return in GSTR 3B. And 3 conditions from supplier point of view. Supplier should report it in GSTR 1, and supplier which reported in GSTR 1 should not be restricted in 2B. If it is restricted in 2B, it is because of supplier only, na. So supplier only should fulfill that condition. One more condition, supplier should have paid the GST by 30th September of succeeding financial year. Otherwise, we need to reverse the ITC. So that is this. Supplier should have paid the tax with respect to such supply within September 30th of next financial year, as per Rule 37A. Input tax means what? CGST. Sir, can you close the door, sir? Thank you. So input tax means CGST, SGST, UTGST charged on supply of goods or services are both made to a registered person. It also includes tax paid on reverse charge. That is, whatever tax I paid to my supplier under FCM or I pay under RCM, both can be taken as credit, and even IGST paid on import of goods also can be taken as credit. Keep that in mind. IGST on import of goods we are not paying under GST, we are paying under customs. But even that IGST paid on import also can be taken as ITC here, and it does not include tax under composition scheme. First of all, a person who is under composition scheme should not charge GST to you. But even if they charge GST to you, you should not have taken ITC with respect to that. So that's what they have excluded. Moreover, now practically it will not be coming because he will not be filing GSTR1. So how it will be reflected in 2B now? And what are the contents of tax invoice? That is, there are some minimum details that should be present in a document to be called as a valid invoice for availment of ITC. What are those minimum details? GSTN of supplier should be there, GSTN of recipient should be there, and description of goods or services should be there, value should be there, GST should be there, and place of supply should be there. These are the 6 minimum details that should be present. Description, GSTN of supplier and recipient, value, tax, and place of supply in case of interstate supply. So if the invoice does not contain all the specified particulars but contains the following details, ITC can be availed by such person. And what is the inward supply on which we take the ITC? Either the inward supply can be inputs or input services or capital goods. Inputs means those goods which are purchased but not capitalized in the books is inputs. If it is capitalized in the books of the purchaser, it will be capital goods. And any service which is received will be input services. And this deemed delivery point already we discussed. Then, if goods are received in lots or installments, when can we avail ITC? Only on receipt of last lot or last installment we can avail the ITC. ITC shall be availed only on receipt of last lot or installment of goods with respect to an invoice. Then next, reversal of ITC for non-payment of consideration to supplier. This is rule 37, and remember this last lot point is applicable if the goods are received against an invoice. For a single invoice, if the goods are received in lots or installment. What if every installment they are giving separate invoice? Then in that case, respective invoice we can take ITC. For example, you are placing an order for 100 units of a particular product, and first month they delivered 40 units, second month they delivered 30 units, and last month they delivered the balance units. So third month only you can take ITC for all these units if there is a single invoice. What if they gave separate invoice for 40 units, 30 units and 30 units, then respectively you will be able to take. And reversal of ITC, rule 37, if the payment is not made to supplier. So recipient making payment to supplier is not a condition for availment of ITC. Recipient may make payment or may not make payment to supplier. Recipient can definitely take ITC, because in the condition for ITC it is not given that recipient should make payment to supplier. So remember, if the recipient is not making payment to supplier, please concentrate, because this is an important point. In many questions it has been tested. Recipient is not making payment to supplier within 180 days, like that it will be given in question. Even then recipient can avail the ITC. Only after non-payment they need to reverse the ITC. So this month they can take ITC, even though they are not going to make the payment within 180 days. Now they can take ITC. As and when they are not making payment to supplier within 180 days, at that time they need to reverse the ITC with interest. With interest. At what rate? 18%. From which date to which date? From the date of utilization till the date of reversal or payment. If recipient has not made payment, value plus tax to supplier within 180 days from the date of invoice, then so much of the ITC proportionate to the amount not paid to the supplier needs to be reversed along with interest at 18% from the date of utilization till the date of reversal. However, if the ITC availed is not at all utilized, means what? You maintain the sufficient balance of ITC every month, then no interest not payable if the availed ITC is not utilized. For example, within 180 days we paid 60%, 40% is only not paid. Now to what extent we need to reverse the ITC? Only to the extent of 40%. Again, we have not made payment to supplier within 180 days, so entire 100% we reverse, 100% of ITC. Thereafter we paid 75%. How much we can re-avail? That 75% can be re-availed. For re-availment, is there any time limit? No. So we have seen re-availment in two places. One is rule 37, this rule, that is we have not made payment to supplier within 180 days, so therefore we reverse the ITC. Again, as and when we make payment to supplier, we can re-avail without any time limit. Same way 37A, supplier did not file GSTR 3B by September 30th, so we reverse the ITC. As and when supplier files 3B at a later point of time, we can re-avail the ITC. In these two cases of re-availment under 37 and 37A, there is no time limit. Happily we will be able to take that ITC. And this interest is lost. In both the places, interest whatever is paid is lost. And this above proviso is not applicable in case of 71C. Supply itself is without consideration, wherefrom recipient will make payment to supplier within 180 days. Not possible. Number 2, that is RCM 9394. So whenever GST is payable by recipient under RCM, then also this 180 days condition is not applicable. Number 3, 15(2)B, payment made to some other person on behalf of the supplier. Already the payment has been made to a third person on behalf of supplier. So 180 days condition is not applicable in this case. ITC can be re-availed as and when payment is made to supplier after 180 days, but interest cannot be availed as ITC, and there is no time limit for re-availment. Then section 16 subsection 3 says that if depreciation under section 32 is computed on the tax component while doing the WDV calculation, then to that extent ITC cannot be availed. If depreciation under section 32 is computed on full invoice value including GST, then ITC cannot be availed. For example, purchase price of the capital goods is 10 lakhs. GST on the same is 1,20,000. Now the depreciation should be computed only on 10 lakhs. If the depreciation is computed on 11,20,000, then ITC with respect to 1,20,000 is not available. Okay. Then also remember this, whenever they reverse the ITC, that reversed ITC will be added to the asset. So therefore it has a connection between GST and income tax. So in income tax, so while doing the WDV calculation, whatever ITC we reversed in GST, that you please add as a value. So in opening WDV, addition is there na? In that addition, ITC reverse needs to be added. ITC reversed on capital goods needs to be added there. You got it? Again, initially we would not have taken ITC. At a later point of time, we will take ITC. At that time, you should show it as a reduction. For example, Rule 43 says that initial purchase, you use the capital goods for exempted. At a later point of time, you use the capital goods for taxable purpose. Then in that case, you can avail the ITC. You can avail the ITC after reducing 5% for every quarter or part thereof. From the date of purchase till the date of conversion, you can avail the ITC. But when you avail that ITC, already you would have capitalized that for the asset now. Now what you should do? You avail the ITC. To what extent you are availing, that should be shown as a sale while doing the WDV of the block. Opening WDV, add purchases, minus sales, closing WDV. In IBS, definitely this point will be tested. Keep this in mind. Whenever we reverse the ITC on capital goods, that should be added. Whenever we avail the ITC on capital goods, that should be reduced from the WDV of the block. Okay, that is this. So purchase of capital goods 10 lakhs, GST on the same is 1 lakh 20. If depreciation is computed on 11 lakh 20, then ITC with respect to 1 lakh 20 is not available. And time limit for availment of ITC. What is the time limit? 30th November of succeeding financial year, or date of filing annual return, whichever is earlier. Whether we need to avail the ITC in November return which is filed, or any return filed by 30th November. How we should understand this? Any return which is filed by 30th November. It's not November return we should take the ITC. Any return that should be filed by 30th November, we should have taken the ITC. That is the meaning. Or due date of filing annual return or actual date of filing annual return. Actual date, not due date. Read carefully. It is 30th November of the succeeding financial year or date of filing annual return. It's not due date. It's date of filing annual return, whichever is earlier. And time limit not applicable in case of re-availment of ITC reversed earlier. What is this? Already we saw Rule 37 and 37A. Whenever we are availing the ITC and we are reversing it and again re-availment, there is no time limit. Happily we can take. Next. In case of debit note, availment of ITC depends on the debit note date but not the date of invoice related to such debit note. Okay. What is this? Invoice is financial year 23-24. Debit note is financial year 24-25. Now we should see the debit notes financial year or invoices financial year. Debit notes financial year. Because for that financial year, by next 30th November, we need to take the ITC. Na? So don't see the invoice date, but see the debit note date for which the debit note is issued, and based on that you determine the time limit for availment of ITC. That is this point. This okay, this old one only. But this is something which is not yet tested. This attempt definitely it will be tested. In case of RCM, whichever date the self invoice is issued, not when it has to be issued, whenever it is actually issued, then only they will be able to take ITC. Whichever date the self invoice is issued. So far what you have been doing in 14 marks question is that the moment you see a RCM liability, you would have taken that in the same month as ITC, correct? What you will see first, RCM liability paid this month, availed as ITC also this month. This is the practice you have been following. Now what you need to do, first check what is the date on which invoice is issued for this RCM self invoice, not the due date when it is actually issued. That month only we can take. Even though January month we paid the RCM liability, but we did not give self invoice for January. We gave the self invoice in March, then March only we can avail the ITC. You got it? Read that. In case of RCM, where the registered recipient issues invoice to unregistered supplier, the date on which recipient issues invoice, not the date on which recipient has to issue invoice, the date on which recipient issues invoice, actual date, is relevant for determining the time limit for availment of ITC. So you just write down there itself, that is, so advocate services to X Limited, advocate services to X Limited on 18th March 2025. Advocate services to X Limited on 18th March 2025, and payment made by X Limited, to advocate on 25th March 2025, but invoice issued by X Limited to advocate on 28th May 2025. On 28th May 2025. Got it? This is the story. What will be taken as the time of supply in this case? What will be the time of supply under section 13 subsection 3? Advocate services to X Limited is covered under RCM. So therefore GST is payable by recipient, that is X Limited under RCM. In this case, who is giving the invoice? Generally, supplier should give the invoice, advocate should give the invoice, but advocate is unregistered. So naturally, who will give invoice? X Limited recipient will give self invoice, correct? In case when invoice is given by recipient to supplier, what will be taken as the time of supply? A. Date of payment to supplier. What is date of payment to supplier? Date of payment to supplier 25th March 2025. B. Date of invoice to supplier, not 61st day. That 61st day is applicable only if invoice is given by supplier. There is an amendment now. The time of supply provision is different. If the invoice is given by supplier, we need to take the date on which payment is made to supplier or 61st day from the date of invoice by supplier, whichever is earlier, as the time of supply. But when invoice is not given by supplier, we need to take the date on which payment is made to supplier or the date of invoice to supplier, whichever is earlier. So date of invoice to supplier. What is the date on which invoice is given to supplier? 28th May 2025, whichever is earlier. Which is earlier? Whichever is earlier, that is 25th March 2025 is earlier. Got it? Which means liability is payable for March 2025. Liability for March 2025. Liability payable for March 2025, but ITC available for come on, May 2025. ITC available for May 2025. Even though you pay the liability in March 2025, but you can take ITC under RCM, self-invoice, whenever month, whichever month you are giving, for that month only. Means March month 3B, you need to report the liability and discharge it by 20th of April. But ITC you cannot avail March month. You have to avail the ITC only in the month of May 3B. May 3B when you will file. So 20th of June you file. So at that time you will be able to take ITC. Keep this in mind, pa. Okay. Again, this point was not tested in last exam. This exam they will test. Last exam they tested time of supply. So therefore time of supply now they will not be testing. They will be testing about the ITC point. Okay. ITC available for May 2025. That is with respect to this. So in case of RCM, where registered recipient issues invoices to unregistered supplier, the date on which recipient issues invoice is relevant for determining the time limit for availment of ITC. And again, which financial year we need to talk about? What is the time limit? What is the time limit? Financial year 24-25 should be taken, or financial year 25-26 to be taken? Financial year 25-26, because March 2025 is last financial year. Now May 2025 is the month in which invoice is given. So it will be now this financial year. So 25-26 should be taken as the year for determining the maximum time limit. Positively by May 2025 they should take. I mean May 2025 3B they should take. If they miss that also at a later date they can take. But what is the final time limit? 30th November 2026, not 30th November 2025. So this can be tested again in MCQ also. It's not 30th November 2025. It is 30th November 2026. see the self-invoice date. Based on self-invoice date, you need to determine the maximum time limit for availment of ITC. Okay, mark this as very, very important. Next, see certain points which I am rushing, certain points which I really explain to you. Whichever I am rushing and whichever I am explaining slow, it is my judgment. I know what is important for exam. When I am rushing something, which means that it is either you know that or it will not be important. Wherever I am going little slowly, which means that these are all some important areas which you should know. Who the hell you are to decide what is important, what is not important? You understood? If you have decided that, you could have cleared long back itself. You got it? Sorry to say this, because some students have messaged me stating that, sir, everything you take in the same pace. Am I a pace bowler or what? To take everything in the same pace. I am a faculty taking the classes. I know where to go fast and where to go slow. Okay, you don't judge me, please. Okay, then say this: time limit for availment of certain financial years. This will definitely not be tested for your exam because it was a provision which already over. For few financial years which has to be ITC availed by 30th November 2021, we can avail now, even though it is violation of section 16 subsection 4. This will definitely not be tested, and its related procedure also will not be tested now, because the application we should have filed by 7th April 2025. So therefore they have removed it in the study material itself. They have not given this. Okay, so don't bother about it. It will not be tested. Trust me, promise, it will not be tested. But this section 16 subsection 6 is very, very important. Time limit for availment of ITC in case of revocation of cancellation of registration. This will be tested. Okay, and already they gave one RTP question also related to this. Please concentrate. What is it about? First, your registration got cancelled. After your registration got cancelled, please focus. Your registration got cancelled. After your registration got cancelled, you have made an application for revocation and they gave a revocation order. There was a period where your registration is actually inactive from the date of cancellation till the date of revocation. And during this time, you could not avail the ITC with respect to the earlier financial year. For example, financial year 2024-25. For financial year 2024-25, what is the time limit for availment of ITC? 30th November 2025. So financial year 2024-25, they need to avail the ITC by 30th November 2025 or the date of filing annual return, assuming the date of filing annual return is 31st December. The due date itself is the actual date. Then whichever is earlier is 30th November only. So financial year 24-25, you have some inward supplies. Whether you avail the ITC on those inward supplies during financial year 24-25, no, you have not taken the ITC. You missed taking ITC because you were under the impression that ITC is not available for you. But actually ITC is available and you missed taking it during this financial year. And next financial year you wanted to take, and somewhere on 1st of June 2025. On 1st of June 2025, your registration got cancelled. Registration got cancelled. And this time also you have not taken any ITC. So even during this period also you have not taken ITC. Exactly on 1/6/2025, your registration got cancelled. On this inward supply here, ITC availed or ITC not availed? ITC not availed. Okay. At least during this stage, ITC availed or ITC not availed? ITC not availed. And here from 1/6/2025 till 31st December 2025, they gave a revocation order. What is revocation order? Revocation of your cancellation. First they gave a cancellation order. So this is the date on which your registration got cancelled. So this is the cancellation order. 1/6/2025, revocation order 31st December. Sir, why 6 months gap and all? Because we have now, what is the time limit for making application for revocation? From the cancellation order, you can make application for revocation within 90 days and it can be extended for a further period of 180 days. After that, they will decide about revocation order. So there is ample time limit for you to make application for revocation. What's the time limit for revocation application? 90 days. It can be extended for a further period of 180 days. And thereafter they will decide whether to give you the revocation order or not in 30 days. So time limit is there. So 31st December they gave a revocation order. Actually this time, so in this period, you cannot avail ITC. Not that ITC not avail, cannot avail ITC. Why cannot avail ITC of this inward supplies? Because during this period 1/6/2025 to 31/12/2025 your registration actually is inactive. You cannot file returns, so you cannot avail the ITC. So what they are telling, you see the period thereafter, after revocation order within 30 days. After revocation order within 30 days, we need to file a return. In that return, they are telling we can avail the ITC of these inward supplies. ITC can be availed. But the time limit for availment of ITC is already over. Because the regular time limit for availment of ITC is what? For financial year 24-25, what is the regular time limit? The regular time limit is 30th November 2025. Even though the regular time limit is over, still you will be able to take ITC. So tell me what is the time limit for availment of ITC in this case? The regular time limit or 30 days from revocation order, whichever is later. That is the time limit by which you can avail the ITC. But this is applicable only in case of revocation of cancellation of registration. Revocation of cancellation of registration. So what is the conclusion that you need to remember? The time limit for availment of ITC in case of revocation of cancellation of registration is given in section 16.6. What should be taken? The regular time limit. What is the regular time limit under 16.4, 30th November of succeeding financial year or date of filing annual return, whichever is earlier, or 30 days from revocation order, or 30 days from revocation order, whichever is later, But very important point here is that the time limit for availment of ITC should not have been expired as on the date of cancellation order. As on the date of cancellation order, if the time limit for availment of ITC is expired, then this subsection is not applicable. This subsection 6 is applicable if as on the date of cancellation. What is the date of cancellation? 1/6. As on the date of cancellation, the time limit is not yet expired, because the time limit is 30th November, not expired, so they can enjoy the benefit of this section. That's what I have given. Provided time limit for availment of ITC not expired as on the date of cancellation of registration. Then we are moving on to apportionment of credit. So section 16 we saw 3 sections, 41, 49 subsection 5 and 16 conditions for availment of ITC. Then 17, see, I am going to complete all the portion, then we will do mighty 50 discussion, so that those 50 questions I selected from various sources, all are from RTPs which are not tested, then some own questions are there. So this mighty 50 questions will be like a compact revision of all the chapters. I will do Q&A, but I will do it at the end. Let's focus on this. Here that small concepts I am explaining. Wherever required, those examples I am giving, but detailed questions we will do at the end. Let me complete the portion first, okay? Apportionment of credit 17.1, 17.2 and 17.3. In short, what it says? If I have inward supplies which is used for non-business purpose. What is non-business means? Not only personal, some other business purpose is also non-business only. For example, if these services are actually consumed by some other person, but invoice is raised to me, I cannot take ITC, because for my business it is non-business purpose, so I should not take ITC with respect to that. Is it clear? So therefore non-business means not only personal purpose but also some other business purpose is also non-business for me. So if my outward supply is personal purpose or non-business, I cannot take ITC with respect to that. So inward supply used exclusively in taxable outward supplies or business purpose, definitely they can take ITC. If inward supply used exclusively in exempted or non-business purpose, ITC not available. If inward supplies are used partly for taxable and partly for exempted, ITC available? Yes. proportionate ITC available. First what we should do? ITC availed minus ITC reverse. Follow this. Don't take total ITC into taxable divided by total in exam. First take ITC availed minus ITC reverse. What is ITC reverse? ITC availed into exempted divided by total. Sir, both cases I will get the same answer. For example, if my ITC avail is 1,20,000 and my exempted turnover is 30 divided by 60 or 30 divided by 90, so that is minus ITC reversed 1,20,000 into 30 divided by 90. 1,20,000 into 30 by 90 is what? How much pa? 1 by 3. 45,000. Oh, sorry, 40,000. 1,20,000 minus 40, that will be 80,000. Sir, directly also I will take 1,20,000. If exempted to total is 30 by 90, then what is taxable to total? 60 by 90. So 60 by 90 will be 80,000. This is also correct only na sir? Practically correct. But exam purpose this is wrong. You have to follow this way only. Show everywhere wherever you are doing computation. First you avail the ITC. Then you need to do the reversal ITC reverse. Availed ITC into exempted turnover divided by total turnover. This way only you need to show in exam. And therefore proportionate ITC available. Same way, when inward supply used for both business and non-business purpose, then also proportionate ITC will be available. And where we need to keep zero rated supplies. Zero rated supplies will be classified as taxable only, even though you are not going to pay any GST on those zero rated supplies under option 2. So zero rated supplies means export of goods or services, supply of goods or services to SEZ. You have two options for payment of GST in case of zero rated. What are the two options? Option 1, pay IGST and get refund of that gross IGST. Option 2, so don't pay IGST and supply it under bond or LUT and get refund of ITC. Now, whether you are going to pay or you are not going to pay, but it will be treated as taxable. So, can you avail the ITC on the inward supplies? Very much yes, we can avail the ITC on inward supplies. Zero rated supplies will be covered under taxable supplies for the purpose of availment of ITC. Then, there is a meaning of exempted supplies. General meaning of exempted supplies which is given in section 2, which is applicable throughout the act, is notified as exempted, nil rated, non-taxable. That is the general meaning of exempted supply for the purpose of payment of GST. You all know whenever a definition is given in section 2, that will be applicable throughout the law. But whenever a definition is given under a particular section, that will be applicable only in that chapter. So this meaning of exempted supply is only for input tax credit chapter. The meaning of exempted supply which is in section 2 is throughout the law. What is the meaning of exempted supply? Generally notified as exempted, nil rated, non-taxable. This is for payment of GST. But for ITC computation, ITC chapter, what will be treated as exempted? So first 3, notified as exempted, nil rated, non-taxable. Then supply covered under RCM. When my outward supply is covered under RCM, actually it is taxable in the hands of the recipient. But for supplier it will be treated as exempted. And next we have, sale of land, sale of building or sale of securities and supply of warehoused goods under customs. These 4 are actually excluded from supply, not treated as supply for payment of GST. Sale of land excluded from supply. Sale of building where enter consideration received after obtaining completion certificate of first occupation, whichever is earlier, excluded from supply. Supply of warehoused goods under customs, excluded from supply. Securities, neither goods nor services. But these 4 transactions are treated as exempted supply. In this supply of warehoused goods under customs, only one transaction is given, that is sale of goods by duty-free shop to incoming passenger. That is only notified. Even though supply of warehoused goods under customs is treated as exempted, not all transactions. Under that they have given only one notified transaction, that is supply of goods by a duty-free shop, where the duty-free shop is in an international airport. To whom they are selling? To outgoing passengers or incoming passengers? To incoming passengers. Then it is not a supply. But even though it is not a supply, it will be treated as exempted supply for ITC purpose. You can see this chart. So somewhere I feel like this point can be tested, because again this is not at all tested so far. So see this, duty free shop in international airport, they are making sale to outgoing passengers and they are making sale to incoming passengers. Sale to outgoing passengers is actually like export. They are taking the goods outside India. So it should be treated like zero rated supply. So sale to outgoing passengers will be treated as zero rated supply. When it is zero rated supply, so they will get refund of ITC. Can they take ITC? Yes. For example, you take Ramraj Cotton. Ramraj Cotton is having a duty free shop in international airport. Now they are buying the garments from their factory. So factory and the shop is distinct person. So the factory has to raise invoice to the shop and the shop will take ITC with respect to that first. And thereafter, when they are making sale to the outgoing passenger, they will treat it as export and due to that reason, they will get the refund of ITC whatever they have. Whereas they will be selling to incoming passenger, those who are coming to India, anyhow they have to pay baggage duty. Any goods which are brought to India, they need to pay baggage duty. So due to that reason, for GST purpose, it is excluded from supply, not treated as supply, treated as sale of warehouse goods under customs. It is sale to incoming passenger. Even though it is not a supply, it should be treated as exempted supply and ITC needs to be reversed. For example, they are buying 100 shirts. Out of that 100 shirts, 40 shirts they have sold to outgoing passengers and 60 shirts they are selling to incoming passengers. With respect to that 60 shirts, whatever GST paid, they cannot avail ITC. With respect to these 40 shirts, they can avail ITC and even they will get the refund of that ITC also. Is that clear? So even though it is not a supply, it is treated as exempted supply for reversal of ITC. How will they maintain this? Definitely they will be easy to maintain because arrival gate is different, departure gate is different. In arrival gate, departure passenger will not come. In the departure gate, arrival passenger will not come. Impossible. So therefore, they will clear cut maintain that records. So because of which they will know how much they are selling to incoming passenger, how much they are selling to outgoing passenger. But remember, sale to outgoing passenger is actually treated as supply of warehouse goods under customs because this duty free shop is like a warehouse. It is like a public warehouse. Duty free shop is like a public warehouse. Any goods which are imported and kept in the duty free shop, they are not required to pay customs duty. So it is like a warehouse. And when the goods are sold to the incoming passenger, it is like sale of warehoused goods and that is excluded from supply. These are the 8 points you need to remember. So notified as exempted, nil-rated, non-taxable, supply covered under RCM, land, building, sale of securities and supply of warehoused goods. In case of land and building, we need to take stamp duty value. Whereas in case of securities we cannot take the sale value because the sale value will be some crores. Because investment will be 10 lakhs, but sale value if you see that will be 1 crore also. How? 10 lakhs we invest, we will not keep it like that. Again we will sell it, buy it, sell it, buy it, sell it, buy it. Throughout the year if you see, the turnover will be somewhere 1 crore also. But we should take only 1% of the sale value of the securities. So in case of sale of securities, the value shall be deemed to be 1% of sale value. Okay. In case of supply of warehoused goods, that duty free shop, see whatever is the price at which the goods are sold, that will be taken. So this is about meaning of exempted for ITC purpose. And there are two transactions. These are actually exempted, but it will be treated as taxable. What is that? Interest on loans, advances, deposits. But this is not applicable to a banking company, financial institution, NBFC. To whom they have to give, they have not given. For a bank, financial institution, NBFC, interest income is exempted for payment of GST. Even for ITC purpose also it will be exempted. Means they cannot take ITC. For others, interest income is exempted for payment of GST. But for ITC purpose, you have to keep it under taxable turnover. Then next one, duty free scrips, sale of duty credit scrips. So under RODTEP scheme, so whenever you are exporting some goods, a percentage of FOB value of exports, you will be given as a duty credit scrip. That duty credit scrip can be used for payment of basic customs duty on import, or you can transfer the duty credit scrip to any other person. This sale of duty credit scrip is actually exempted under GST, but for ITC purpose, it will be treated as taxable. So, services by way of accepting deposits, extending loans or advances, insofar as the consideration is represented by way of interest or discount, except in case of banking company or financial institution or NBFC. Then next one, generally sale of duty credit scrip is exempted, but for availment of ITC it will be treated as taxable. Then next we have Rule 42. Rule 42 talks about manner of availment of ITC with respect to inputs and input services. Please focus. In case of Rule 42, that is whenever you have any question, exempted turnover and taxable turnover and some common inward supplies, no doubt Rule 42 will be applicable. Easily you can find, and definitely in question number 1 only they will be giving this. So you check in the question whether you have exempted supplies and taxable supplies. Yes. And you have some inward supplies. Yes. And those inward supplies, they have not given exactly how much is used for taxable, how much is used for exempted. No doubt this Rule 42 implication will be coming. What does this Rule 42 says? First you see what is the total GST paid on inward supplies. Whatever is the total GST paid on inward supplies. And you segregate that into 4 boxes. What is that? T1, T2, T3, T4. Whatever is the GST paid on inward supplies will be T. And that needs to be divided into 4 boxes. T1, non-business purpose. T2, exempted supplies. T3, blocked ITC. T4, taxable and business purpose. For example, if the total tax paid on inward supply is 4 lakhs. The total tax paid on inward supply is 4 lakhs. Out of that 4 lakhs, if 20,000 rupees is for non-business purpose and some 30,000 rupees is used for exempted and 25,000 is blocked credit, then can we take this 20, 30 and 25? No. That's what I told you, that while doing the self-assessed ITC, whatever is the matched ITC minus T1, T2, T3, blocked credit, inward supply for non-business, inward supply for exempted, you should take out. That's what we have seen, self-assessed ITC. So you need to take out this and you will get some amount that will be called as ITC availed in GSTR 3B. So what is ITC availed in 3B? 4 lakh minus 75,000, that is 3 lakh 25,000 is the ITC availed in GSTR 3B. So while availing the ITC, don't take these 3. Even though reflected in 2B, you should not take these 3. That is inward supply for non-business, inward supply for exempted outward supply and blocked ITC. So if you take out, then the remaining will be ITC availed in 3B, that is called as C1. But in that 3,25,000, fully you will not be getting ITC. There will be some inward supplies which are exclusively for taxable and business, which you can take as credit. What is that? Say for example, 2,50,000 is inward supply which is exclusively used for taxable and business purpose, which means you can get full credit of the 2,50,000, but remaining. So out of 3,25,000, you availed 3,25,000. Out of the 2,50,000 fully for taxable, what is the remainder? 3,25,000 minus 2,50,000, that is 75,000. 75,000 will be taken as a common credit. This 75,000, we need to see how much is used for exempted supply. How to calculate? See the exempted turnover and total turnover. Say 75,000 into exempted turnover is 40 lakhs and the total turnover is 100 lakhs. Turnover, sir, whatever you paid on inward supply, 30,000 is not turnover and this 2,50,000 is not your turnover. That is the GST paid on inward supplies. Now you need to see your outward supply. Based on the outward supply, you will know the turnover. 75,000 into 40 divided by 100. So how much is it? 75,000 into 40 divided by 100. 40%. That is 30,000 we need to reverse. And common credit with respect to non-business purpose. Out of the inward supplies, if you have any one inward supply which is partly used for business and partly used for non-business, we need to reverse the ITC. So therefore we need to take 75,000 into 5%. So because if you know exactly how much is used for non-business purpose, you can put it under T1 itself. If you don't know how much is exactly for non-business purpose, it will travel to common credit. In that case, the total common credit. See, out of this 75,000, one invoice only is partly business, partly non-business. But the entire 75,000 will undergo reversal. So 75,000 into 5%, that is 3,750. So what is the ITC availed in GSTR 3B? Sorry, ITC availed in 3B will be 3,25,000. What is the ITC reverse? ITC to be reversed is 30,000 and 3,750, 33,750. Then the remaining will be called as net eligible ITC. This is the process that you need to follow. So first T, minus T1, T2, T3. So T1 that is non-business, T2 exempted, T3 block to credit, then you will get C1. C1 is ITC availed in 3B. From C1 you need to take T4 which is exclusively for taxable and business purpose, then you will get common credit C2. That common credit attributable to exempted supply into E by F. E for exempted turnover, F for total turnover. So that is 30,000, and common credit with respect to non-business purpose 75,000 into 5%, that is 3,750. But remember, only when you have inward supply which is partly business partly non-business, then only this C2 into 5% will come, otherwise it will not come. And suppose if you have partly business partly non-business and you know exactly how much is for non-business, then also this C2 into 5% will not come. And then so ITC availed 3,25,000 minus ITC reverse, so this 30 and 3,750, 33,750 net eligible ITC. Okay, and you can see here so this is, there are two questions related to this in your study material. I am just giving you, quickly the answer related to this. So this is one question, all in one store, like that one question is there. In this question what has happened, they are doing business across the country and they have some outward supplies in Mumbai. So aggregate value of various items sold in the store, taxable items 42 lakhs, items exempted 12 lakhs, item not leviable to GST 3 lakh. Mumbai store transferred to another all-in-one store located in Goa certain taxable items for distributing the same as free samples. The value declared in that invoice is 5 lakhs. Such items are sold in Mumbai store at 8 lakhs. So here we need to take value under rule 28 because Mumbai store is selling it to Goa store. Mumbai to Goa distinct percent, because of which rule 28 should be taken OMV, and nowhere it is given that recipient is eligible for full ITC. Recipient is not eligible for full ITC given. Where is it given? The recipient unit is going to distribute it as free samples, which means that they cannot take ITC on inward supply. So due to that reason, the open market value only should be taken, not the value declared in invoice, because clearly it is given they are going to distribute the same as free samples. If any purchased goods are distributed as gifts or free samples, they cannot take ITC as per 17 subsection 5 block the credit. Due to that reason, they cannot take credit with respect to that. So the 5 lakhs cannot be taken and we need to take 8 lakhs, that is the open market value. And if you see from this data, you got exempted turnover to total turnover. What is the exempted turnover? 12 lakhs and 3 lakhs will be exempted turnover, and the total turnover will be 42 lakhs plus 12 lakhs plus 3 lakhs plus 8 lakhs, that is 65 lakhs will be taken as the total turnover. So E by F will be 15 divided by 65. Now we need to analyze the inward supplies. In that inward supplies, they have given taxable items 55 lakhs, that will be T4. Inward supply on which GST is paid. So as the GST is paid, it will come in T, and it is used fully for taxable outward supply. So therefore it will be coming in T4. Then inward supplies which are exempted. First of all, we are not paying any GST on that, so it will not come in T itself. And items not leviable to GST, on that first of all we have not paid GST, so it will not come in T. Then freight paid to GTA for outward transportation of taxable items. So on freight we are paying GST, and that is 1 lakh we pay GST, but it is used exclusively for taxable outward supplies, so it will be kept in T4. Again, freight paid to GTA for outward transportation of exempted items 80,000, first we pay tax, and that will come in T, and it is used for T2 because used for exempted outward supplies. Same way sixth point also. So first we pay GST on 20,000 and it is used for exempted outward supply, and all these three cases we pay GST under RCM. Usually GTA services will be RCM if the question is silent, and here in this question clearly they have mentioned that it will be 5%. GTA has not exercised the option to pay tax itself. For GTA there are two options, FCM option and RCM option. If it is FCM option, they need to pay GST at the rate of 12% under FCM with ITC or 5% without ITC. Whereas in case of RCM, always the rate will be 5%. They are not opting to pay tax itself, means definitely it will be RCM. So these three GTA services will be covered under RCM. Monthly rent payable for the complex 5,50,000, And this is the point I wanted to stress. 5,50,000, 1/3 of the total space is used for personal residential purpose, which means 1/3 is used for non-business purpose, and that is given, which means that we pay GST on this and 1/3 we keep in T1. So therefore the D2, that is C2, common credit into 5% point, will not be applicable in this case, because here you are able to segregate that 1/3 is for non-business purpose. Activity of packing the items and putting the label of the store along with the sale price. So this is normal common credit. So 2,50,000 on which you pay GST. Salary, first of all, it is excluded from supply, so there is no tax on this. And then GST paid on inputs. So far it is values, but this is GST paid directly. So tax, and it will come in T1 because it is used for personal purpose. And GST paid on rent-a-cab. Rent-a-cab is blocked credit. So we are paying tax, but it will be coming in T3, blocked credit. And GST paid on items given as free samples. We pay tax, but it will be coming in T3. So like this, you need to mark all your inward supplies. Thereafter, we need to take first T. So the T will be taken as the total tax paid on inward supplies minus T1. So what is the T1? Here 1/3 will be in T1. So 5,50,000 into 18%, because all other inward supplies will be taxable at the rate of 18%. So therefore T will be the total tax paid on inward supplies. That what you need to do, everything you need to calculate. How you need to calculate? That is 55 lakhs into 18%, then 1 lakh into 5% because GTA, and then 80,000 into 5%, 20,000 into 5%, then 5,50,000 into 18%, then 2,50,000 into 18%, then 5,000, 4,000, 4,000, like that. If you add everything, you will be getting some 11,57,000 something you will be getting, and from that you need to take out T1. So what are the T1s? 5,000 rupees, and here also 5,50,000 into 18% into 1/3. So that 33,000 will come. That should also be taken out, T1. T2 will be like exempted. So 80,000 into 5%, 4,000. And then any other place we have T2? No, nothing. This 20,000. 20,000 into 5%, 1,000. So 5,000 we need to reduce. And thereafter T3. T3 we have two numbers, 4,000 and 4,000. Now you will be getting ITC availed in GSTR 3B. ITC availed in 3B minus. So ITC availed in 3B will be 11 lakh, 6,000 you will get. And thereafter you need to take out T4. What is T4? 55 lakhs into 18%, 9 lakh 90,000, and 1 lakh into 5%, 5,000. So 9 lakh 95,000. When you take out from 11 lakh 6,000, you will get common credit 1 lakh 11,000, and common credit attributable to exempted 1 lakh 11,000 you got. Into exempted turnover already you have in the question beginning itself, 15 divided by 65. So 1 lakh 11,000 into 15 by 65, 25,615. And common credit attributable to non-business is not there. So D2 is not there because already you segregated that, and no other inward supply is used for partly business, partly non-business. So you don't have to do any reversal with respect to this. And this will be net GST payable. Why net GST payable 10,000? Because if you see here, we have lot of credit. 11 lakh 6,000 we availed ITC. 11 lakh 6,000 we availed ITC. From the 25,615 will be ITC reverse. What is the net eligible ITC that we have? 10 lakh? Come on. So 11 lakh 6,000 minus 25,615. 10 lakh 80,385. This will be the net eligible ITC. And gross liability, if you see, so 42 lakhs is taxable, 8 lakhs is taxable, total 50 lakhs. 50 lakhs into 18% will be 9 lakhs. So this 10 lakh 80,385 can be used for 9 lakhs. So FCM liability will become 0. But RCM liability should always be paid. Even though you have excess credit, that excess credit cannot be used for payment of GST under RCM. RCM liability should always be paid through cash ledger, and the RCM liability will be with respect to this GTA service. 1 lakh into 5%, 80,000 into 5%, 20,000 into 5%. So 10,000 rupees will be taken as a net GST payable. That is this. Okay. So tomorrow you do this. You do this question. I am quickly explaining this to you. And one more question is also there. Van Shopee, like that, this question. In this question also the same rule 42 is applied. But here what they did is that they gave all the expenses, and none of these expenses is used for non-business purpose. If you analyze, here also we have turnover data. Taxable goods 50 lakhs and items not liable to GST 10 lakhs. So 10 divided by 7. So 10 divided by 70, will be, 60 will be taken as exempted to total, correct or not? So exempted will be 10 lakhs and total will be 60. That is easy. But if you see the inward supplies, taxable goods. So T4, goods not available, no tax. Monthly rent, tax is paid. Telephone expense, tax. But none of this is non-business purpose. And audit fees, tax is paid. Premium paid on health insurance. Health insurance is blocked credit. You cannot take ITC. Freight paid to GTA. So tax thereafter T2, T4. And goods given as free samples, T and T3. None of the inward supply is used for non-business purpose. So in this answer, there won't be D2 into 5%. That's what. This 5% of common credit, you need to apply only if you have partly business, partly non-business, or like if you are able to identify exclusively for non-business how much, this will not be applicable. So that's the discussion related to this. Then next one, this computation should be made separately for ITC of CGST, SGST, UT, GST and IGST, and this D1, D2 should be again computed at the end of the financial year. At the end of the financial year, we need to again compute this, and after that you need to compare. So month on month D1 and D2 versus D1 and D2 computed at the end of the financial year. If month on month what you have computed and annual what you have computed, if there is any reversal which you need to make. For example, summation D1 plus D2. So every month is somewhere like 1,80,000 every month throughout the year. But finally you computed D1 and D2 annual. D1 and D2 annual is somewhere like 1,60,000. So how much you reversed? 1,80,000. How much you should have reversed? 1,60,000. So you made a excess reversal. That excess reversed credit can be reavailed as ITC, not at all a problem. And suppose if it is 1,80,000 what you have reversed and what you need to reverse is 2 lakhs, then in that case 20,000 rupees there is a shortfall. That 20,000 rupees you need to reverse and you need to pay interest also. In this case, from 1st April of the succeeding financial year, say this. D1 and D2 will be computed for the whole financial year by taking exempted turnover. Again, this is an untapped area. This particular area they have not tested in exam so far. So therefore, they can ask this. D1 and D2 will be computed for the whole financial year by taking exempted turnover and aggregate turnover for the whole financial year. If this amount is more than the amount already added to the output tax liability every month, the differential amount will be added to the output tax liability. I told you already, 1,80,000 is what you need to reverse. So 1,80,000 is what you have reversed, then 2 lakhs is what you need to reverse. Then the 20,000 rupees you need to reverse by 31st March of the financial year, because you need to compute it by 31st March. If you are not reversing from 1st April of the succeeding financial year till the date of payment, you need to pay interest at the rate of 18% per annum. Suppose if this amount is less than the amount added to output tax liability, for example, what you have reversed is 1,80,000, what you need to reverse is somewhere like 1,60,000 or 1,50,000 like that, then that 30,000 rupees what you have reversed in excess, you can reavail by September of the succeeding financial year. So the additional amount paid can be claimed back as credit in the return of any month that is filed till September of the succeeding financial year, but not November. Be careful, it's not November, it is September. By September of the succeeding financial year they can take. That is about rule 42. Then rule 43. Sir, why will there be difference? Definitely there will be difference because the sum of the ratio will not be equal to the total. For example, month 1 5/8, month 2 will be 3/8, 3/6, month 2 will be 3/6, and month 3 will be somewhere like 4/8. Okay, 4/12 you take. Now month on month when you do versus cumulatively when you do, definitely it will change because the sum of ratios is not equal to the total. You cannot just like that add. We can add like that mathematics we don't have. Okay, so definitely it will change. Month on month when you take versus total numbers when you take, that is 5/8 plus 3/6 plus 4/12 is not equal to the sum of numerator and sum of denominator. Then LCM rest in peace. You understood or not? You got it? So it is not possible. So definitely it will change. Month on month calculation versus yearly calculation, it will change. So because of that only they have given this. And one more important point to keep in mind, if there is utilization ratio that is given, then what you should have done, the utilization ratio only you should take. Okay, so say utilization ratio utilization ratio of E by F, exempted to total, utilization ratio of exempt to total 10 by 40, and turnover ratio E by F, turnover ratio E by F is somewhere like 30 divided by 60. So utilization ratio is 1:4, whereas turnover ratio is 3:6. Then in that case, which should be taken for reversal? Whether utilization ratio should be taken or turnover ratio should be taken? Utilization ratio only should be taken, because first if you are able to segregate between T1, T2, T3, that only you should follow. So why will there be difference? Utilization ratio is the production input used for exempted production and taxable production, but not everything produced you need to sell. There will be closing stock, so there will be sales different. So therefore, if the production data you don't have, then only you need to go with the turnover data. So therefore, if you know how much is exactly used in the production, you divide it based on that, because to confuse they will give both. They will give production data also and they will give you turnover data also. Blindly what you will think, SAR said exempted turnover divided by total turnover, like that you will take, and then you will send a message, you only taught me like that, you are responsible for my failure. How will I responsible for your failure, pa? So you listen properly, idiots, you have to listen properly, got it? Don't blame me. Okay, so utilization ratio E by F of utilization ratio given, that only should be taken. If that is not there, then only the turnover ratio should be taken. Okay, don't forget this. Then next one, say this rule 43, manner of availment of ITC with respect to capital goods. Because whenever the pressure is there for the student, they put it on me. Then where my pressure I have to put? Should I put it on my family? You understood? So everyone, left, right, center, they are playing football match with me. So wherein, sir, so I listen to you, I fail, too much pa. Then ask every ranker to dedicate their rank to me only, na? Whatever salary they are earning, they have to give it to me. Then I will take up responsibility of yours. So rank is also not my responsibility, failure is also not my responsibility. I teach the same for everyone. You got it? So you have to listen to it properly. Your frustration, you will put it on me. Okay, to extent. So say this. Rule 43 of CGST rules, manner of availment of ITC with respect to capital goods. That is, you are purchasing some capital goods and you are using it for taxable or business purpose. Can we take ITC with respect to this capital goods? Yes, very much yes. And you are buying some capital goods which is used for exempted or non-business purpose. Can we take ITC with respect to this capital goods? No. Whereas capital goods which is partly used for business or taxable and partly used for exempted and non-business, can we take ITC? Yes, but this will be called as common ITC, and common ITC we need to divide between exempted to total every month over a period of 60 months. What is the treatment in case of common capital goods too? First you avail the 100% ITC in the month of purchase itself and credit it to the electronic credit ledger. Thereafter, every month over 60 months, compute the monthly ITC. How much is the monthly ITC? ITC avail divided by 60. Assumption, life of the capital goods will be taken as 5 years or 60 months. Suppose in the question they gave 48 months, take 48 months. In the question they gave 36 months, take 36 months. If the question is silent, you take 60 months, because the life of the capital goods will be 60 months. If the question says 48 months, you don't take 60 months, definitely the answer will be wrong. So because the law says up to 60 months, which means even less than that also can be given, that should be taken. So ITC avail divided by 60 months, you will get monthly ITC. What you need to do with monthly ITC? Every month you need to see what is the exempted turnover and what is the total turnover. So that month ITC into E by F we need to reverse. For the next 60 months from the date of purchase, compute monthly ITC attributable to exempted supply. What is that monthly ITC? Attributable to exempted supply, monthly ITC into exempted turnover for that month divided by total turnover. Here there is no utilization ratio and all, because capital goods, how much is used for exempted and how much is used for taxable, we cannot determine in production. So therefore we need to definitely take the turnover ratio only. So that's the reason why exempted turnover divided by total turnover. And this ITC what you reverse, we need to pay interest also. at the rate of 18% from the date of availment till the date of reversal, but this interest point is omitted for you. It will not be tested in exam because CA Institute is not happy with this interest. So therefore this interest, they have not given any computation. They just said interest as applicable in the study material, and that's why from 2018 to 2025, not even one question is there related to this interest, but the provision is there, okay, at the rate of 18% from the date of availment of ITC till the date of addition of output tax liability is paid. Usually interest will be on ITC utilized, but this is the only place where it is ITC availed. And whenever the capital goods too is not with you, whenever the asset itself is not with you, whether you need to do the monthly reversal, no. The above procedure not required from the month in which the capital goods are sold. Because whenever the capital goods are sold, the asset is not with you, so that EBF reversal is not required. But whenever the asset is sold, you need to pay GST as per 18.6. What is that 18.6? Whenever capital goods are purchased, on which ITC is availed, and the capital goods are supplied. 3 points. Capital goods purchased, ITC availed, capital goods are supplied. How much is the GST payable as per 18.6? A. ITC availed minus 5% for every quarter or part thereof. From where to where? From the date of purchase till the date of sale, or GST on sale value of the capital goods. Whichever is higher should be taken, as GST is payable under section 18 subsection 6. Then look into this. Initially you purchased capital goods and you used it for taxable outward supply. Initial purchase used for taxable outward supply, and a later point of time you are using it for common. Then what is the treatment? So initially at the time of purchase, say for example, as on 1/10/2025 you purchase the capital goods, and at that time you have used this capital goods, or I'll just change the date to say 1/4/2025. So what is the life of the capital goods? 31/3/2030, correct? 5 years, 60 months. So 1/4/2025 to 31/3/2030 will be taken as the life of the capital goods. So total 60 months. Somewhere after 24 months, that is 1/4/2027, exactly what happened? It became CG2, capital goods 2, means common, and initially purchased it was CG1, means it was used exclusively for what purpose? Taxable purpose, means you would have taken ITC at that time itself, that is 1/4/2025 itself ITC would have been availed. Now it became common. When it became common, don't take ITC again, because ITC already availed at that time. Now you need to consider it as common, and you need to do the E/F reversal for the remaining 36 months. For this remaining 36 months, you need to take monthly ITC. So that is total ITC divided by 60. Don't change 60, because the life of the capital goods will be 60 into E/F every month. But for how many months you need to do this? Only for 36 months. The reversal you do for 36 months, but denominator don't take 36. Denominator should be 60 only. ITC availed should be same, no change. ITC availed, original ITC divided by life is 60, but only thing the E/F computation you do for the remaining life. First 24 months you used exclusively for taxable, so you can enjoy that ITC. That is this. ITC already availed at the time of purchase, so no need to avail the common credit. Monthly ITC will be original ITC divided by 60 months. Proportionate reversal from the date of conversion for the balance life. For computation of interest, consider ITC availment as the date of conversion. Then next one, initially you purchase the capital goods, and at a later point of time and you use it for CG3, means what? Exempted. At a later point of time you are using it for both taxable and exempted. Say 1/4/2025 you purchase the capital goods, and 31/3/2030 initially you purchased and used for CG3. ITC availed or ITC not availed? ITC not availed, because it is used for exempted outward supply. And exactly 24 months. After 24 months, what has happened? On 1/4/2027, you are using it for CG2, means common capital goods. Initially you did not take. Whether you need to take ITC now? Yes. ITC availed. How much is the ITC availed? Say at that time we purchased the capital goods for 10 lakhs. 10 lakhs excluding GST at 18%. Then we would not have taken ITC at that time. Now we need to take the ITC 1,80,000. Why we need to take ITC 1,80,000? First you need to take the ITC 1,80,000 total ITC. Thereafter, for the last 24 months you are using it for only exempted. So due to that reason, you reverse it for past. So what is the past reversal? What is the past reversal? Past reversal will be 1,80,000 into 5% into how many quarters? So 8 quarters. Why 8 quarters? Because 2 years you are using it for exempted. So you need to reverse 1,80,000 into 5% into 8 quarters. You need to reverse. This is for past period. Plus for remaining 36 months. For remaining 36 months, there will be future reversal. Why future reversal for remaining 36 months? Because you are using it for both taxable and exempted for the remaining 36 months. So monthly ITC divided, whatever is the total ITC divided by 60. Total ITC, that is 1,80,000 divided by 60 into E by F. That you need to do for 36 months. So past reversal also will be there, future reversal also will be there. In this, what they will do, they will put a twist. So rather than 1/4/2027, they will keep it like 5/4/2027. Then what will happen? So what you need to reverse for the past reversal is not for 8 quarters, for 9 quarters, because 5% for every quarter are part thereof. So for 9 quarters you will reverse. Okay, va? But future reversal from April 2027 means 36 months only. So when you take 9 quarters, means here 3 months you need to cut. No, they will not cut. Okay. So past reversal also you need to do, future reversal also you need to do for 3 months. Be careful with respect to that. Okay. So for the 3 months, because when you take 9 quarters, means literally you should reverse it only for 33 months in future. But they are telling from the month of conversion you need to do the future reversal. So therefore 36 months. That is this ITC not availed at the time of purchase, so it should be availed now. Whatever is the original GST paid. Ineligible ITC to be reversed for the period it is used for exempted, that is past reversal. What is a past reversal? GST paid into 5% into number of quarters are part thereof. Part thereof from the date of purchase till the date of conversion. And monthly ITC equals to original ITC divided by 60. No change in that. Proportionate reversal from the date of conversion for the balance useful life. So interest will be computed from the date of conversion. And related to this, you see this question. One question is there on capital goods also. XYZ Private Limited is a manufacturing company, GST registered. They are making 3 products, alpha, beta, gamma. 1st October, beta got exempted through an exemption notification. Exemption available on gamma got withdrawn. So that is they are making 3 products. Alpha, beta and gamma with effect from 1st October. Alpha is taxable, beta is taxable, gamma is exempted, and with effect from 110 it changed. So alpha is taxable only, beta became exempted and gamma became taxable. That is given in the first paragraph. XYZ Private Limited has furnished the following data, and now for October month what is exempted? Only beta is exempted and the other 2 is taxable. So beta turnover is 10 lakhs and the other 2 9 lakhs and 6 lakhs. So what is the ratio of exempted to total for October month? Exempted turnover will be 10 lakhs and the total turnover will be 25 lakhs. Now, machinery U is purchased on 1st October, 36,000 used for all the 3 products. Means can we take ITC? October month only they are purchasing. Definitely we can take ITC, and also as it is used for all the 3 products, it will become common ITC. Machinery we purchased on 1st October used only for alpha and gamma. Alpha and gamma is now taxable, so due to that reason they can take ITC with respect to that, and it is not common. Machinery W purchased on 1st October for being exclusive used in manufacturing beta. Beta is exempted, so we cannot take ITC and it is not even common. And machinery Y purchased on 1st October 4 years ago, 4 years before, for being exclusive used in manufacturing beta. 4 years before beta was taxable. So initial purchase used for taxable. And now they are using for making gamma also, which means that now they are using for beta and gamma, so it will become common. And initial purchase they would have taken ITC because it was used for taxable, so no need to take ITC now, just consider it as common ITC. Then machinery Z purchased on 1st October 2 years ago for being used in manufacturing all 3 products, So means at that time itself the ITC would have been taken. So no need to take ITC, just consider it as common ITC. Raw material used for manufacturing alpha purchased on 5th October. So alpha is taxable. So due to that reason they can take ITC on 27,000. Raw material used for manufacturing beta purchased on 10th October. Beta is exempted, so they cannot take ITC with respect to that. Raw material used in manufacturing gamma purchased on 15th October, so taxable, so we can take ITC with respect to this. What is the total ITC availed? So the total ITC availed is this 36,000 plus 18,000 plus 27,000 plus 18,000, 99,000 is the total ITC availed. Now we need to check the ITC reversed with respect to capital goods. What is the common credit with respect to capital goods? 36,000 plus 72,000 plus 54,000, 1,62,000. 1,62,000 is the common credit on capital goods. How much is the ITC to be reversed on capital goods? 1,62,000 divided by 60 into exempted turnover divided by total turnover. Exempted turnover will be 10 divided by 25 into 10 divided by 25. 1080 is the ITC reverse. So ITC availed 99,000, ITC reverse 1080, net eligible ITC 97,920, and gross liability is available here itself. Taxable turnover will be 15 lakhs, 9 and 6. 15 lakhs into 18% will be 2 lakh 70 minus 97, 920. 1 lakh 72,080 is the net liability. This is the answer for this question. And they have not given one point in this question. Initially purchase exempted, at a later point of time common is not given in this question. That can be tested, because they will give in study material how to make rice, but in exam they will ask how to make chicken biryani. Okay, so therefore they will ask that point. And next, one more point also here, sir, this machinery Y is used for only beta and gamma. Why are we taking all three machineries ka turnover? That is all three products turnover. Why are we taking? We should take only beta and gamma turnover only na for apportionment. No, because rule 43 says even if a machinery is used only for two products, but the computation will be made for all the capital goods, common capital goods together. So together only you need to do the computation. So therefore 1,62,000 together, even though out of this one machinery is only for alpha and gamma, irrelevant of that. So we need to take all the machineries common credit divided by 60 into exempted divided by total. This is given in the rule 43. So this only should be followed. That is about this. Then whether ITC to be reversed by life insurance company on the portion of premium not included in the value as per rule 32 sub rule 4, that is usually rule 32 sub rule 4 for single premium annuity, 10% of single premium in case of reinvestment policy, premium collected minus amount allocated for investment, first year premium into 25%, subsequent year premium into 12.5%. The remaining portion, whatever is not taken into the taxable value, should we consider it as exempted value. For example, there is an insurance company, you take life insurance, normal policy, 25% of first year premium means 75% is exempted. Then 12.5% should be taken. So remaining 87.5%, should it be treated as exempted? No. The taxable value itself is 25% and 12.5%. The remaining should not be considered as exempted. So the insurance company is not required to reverse any ITC because of this. Got it? So premium value not included in the taxable value. What is not included? First year premium you take, but 25% only. Remaining 75% it will not be included. Correct or not? So that 75% don't treat it as exempted. Just ignore it. That is not exempted. So taxable value is not considered as exempted or non-taxable supply. Therefore, ITC reversal shall not arise in terms of rule 40 to 43. Not tested. Not tested. This point is not tested in May exam as well as in September exam. So this is an amendment which can be tested for JAN exam. Then 17 subsection 4, option available to a banking company, financial institution or NBFC. That is, for banking, financial institution, NBFC, there are two options. Option 1 will be proportionate ITC. Option 2 will be 50% ad hoc ITC. But proportionate ITC or ad hoc ITC, they need to decide in the beginning of the financial year, and that will be applicable throughout the financial year. And in case of option 2, there are some special points, keep that in mind. If there is some inward supply from a distinct person, they can take full ITC. For example, HDFC Bank Karnataka has inward supply from HDFC Bank Tamil Nadu, they can take full ITC even though they are under ad hoc ITC option. And even common ITC they will take 50%, exclusive used for taxable also 50%, exclusive used for exempted also 50%. But in proportionate ITC it is not like that. exclusively used for taxable, we will take full ITC, common only will take proportionate, exclusively for exempted, we will not take. But option 2 is not like that. Option 2 we will take common also 50%, exclusively for taxable also 50%, exclusively for exempted also 50%. In both the places, blocked credit we will not take, inward supply for non-business purpose we will not take. So in case of option 2, inward supply exclusively used for non-business purpose and blocked credit, ITC should not be availed. But 50% compute on remaining ITC. What is that remaining ITC? Including used exclusively for exempted and used exclusively for taxable. One more, in case of option 2, the restriction of 50% shall not apply to tax paid on supplies made to another registration within the same entity. So no need to reverse 50% with respect to inward supply from distinct person. And option 1's excise cannot be withdrawn during remaining part of the financial year. And this 17 subsection 4 is applicable for only banking company, financial institution and NBFC. Then what we have is blocked credit, and it will take some time. Okay, fine. From here, let's see in the next class. Okay. So what you need to do is that with respect to tomorrow, you need to complete value of supply and input tax credit. And I'll tell you what are all the portions which we are going to discuss tomorrow. So tomorrow we will be covering this search, seizure, offence and penalties, demand and recovery, appeals, advance ruling, because that is a neglected area. Usually you will not be preparing at all with respect to that area. That's why those area we will be discussing tomorrow. Then any person who learn for first time can still sit here. Please don't. So you will not understand anything and you will hate me throughout your life. So please don't. Do we need to follow the same method, or can we show net ITC, net of common credit reversal as ITC created to electronic credit ledger? Do we need to follow the same? See, T1, T2, T3, not because I am Tarun Raj, my name I have given. Law itself uses the word same. Okay. So therefore you need to follow that denotion only. You don't follow K1, K2, K3 like that and all, because the evaluator will not understand what it is. So this is the denotion given in the rule, we need to follow that. If you are not following it, at least you need to explain what it is, because otherwise in computation what you will do, because you have to follow this format, template, then only you will get the correct answer with respect to this. Okay. Then in one of the solve workbook questions, were asked to find ITC created to electronic credit ledger. Answer was gross ITC. Added common credit reversal without output. ITC credited to electronic credit ledger means C1. That is total tax minus T1, T2, T3. That is the meaning of ITC credited to electronic credit ledger. Sometimes eligible ITC like that it will be asked. What is eligible ITC? ITC availed minus ITC reverse. And there is one MCQ that also you need to practice tomorrow. One question related to ABC petroleum, like that one question is there. Okay. Case scenario MCQ, and that question they have asked in last RTP also. September RTP MCQ, one MCQ is there, that also you try. That petrochemicals related question. There they have asked the question related to rule 42 and 43. So these are some questions, you please try at your end. That's it. Thank you. So tomorrow we will continue with this discussion and we will complete it. So my target is that by Friday I wanted to complete the entire theory discussion, and Saturday I wanted to reserve for Mighty 50. But meanwhile, some study material questions which are really where you need to focus, I'll discuss. But I'll discuss in fast manner, you practice it at your end once. Okay. Thank you.